Indian Economy by Ramesh Singh. Chapter 12. Banking in India. Banks are perhaps the most important financial intermediary. In the 19th century, banks mainly lent money to firms to help finance their inventories, which were held as collateral in the cases of defaulters banks seized them. Gradually, banks expanded their lending activities to finance houses and commercial real estates, holding the buildings as collateral. Emergence of information technology has presented special problems to these traditional forms of finance. If the idea does not pan out, the firm may go bankrupt, but there is no collateral, there is little of value that the creditor can seize. Introduction. The sense in which we today use the term banking has its origin in the Western world. It was introduced in India by the British rulers, way back in the 17th century. Since then a number of changes have taken place in the sector, and today Indian banks are among the finest in the emerging market economics, well directed towards becoming global. Nbfcs. Bank is a financial institution engaged primarily in mobilizing deposits and forwarding loans. The deposits and loans are highly differentiated in nature. Banks are regulated by the Central Bank of the country, in case of India, the RBI, Reserve Bank of India. The another category of financial institution, the non-bank, is almost similar in its functions, but main difference, though highly simplified, being that it does not allow its depositors to withdraw money from their accounts. NBFCs, non-banking financial companies, are fast emerging as an important segment of Indian financial system. It is an heterogeneous group of institutions, other than commercial and cooperative banks, performing financial intermediation in a variety of ways, like accepting deposits, making loans and advances, leasing, hire purchase, etc. They cannot have certain activities as their principal business: agricultural, industrial, and sale, purchase or construction of immovable property. They raise funds from the public, directly or indirectly, and lend them to ultimate spenders. They advance loans to the various wholesale and retail traders, small-scale industries, and self-employed persons. Thus, they have broadened and diversified the range of products and services offered by a financial sector. Gradually, they are being recognized as complementary to the banking sector due to their 1. Customer-oriented services, 2. Simplified procedures, 3. Attractive rates of return on deposits, and 4. Flexibility and timeliness in meeting the credit needs of specified sectors. RBI, the regulator of the NBFCs, gives a very wide definition of such companies, a kind of umbrella definition: a financial institution formed as a company involved in receiving deposits or lending in any manner. Based on their liability structure, they have been classified into two broad categories: 1. Deposit-taking NBFCs, NBFCD, and 2. Non-deposit-taking NBFCs, NBFC-ND. It is mandatory for a NBFC to get itself registered with the RBI as a deposit-taking company. For registration they need to be a company, incorporated under the Companies Act, 1956, and should have a minimum NOF, net owned fund, 2 rupees crore. To obviate dual regulation, certain category of the NBFCs which are regulated by other financial regulators are exempted from the regulatory control of the RBI. 1. Venture capital fund, merchant bank, stock-broking firms. SEBI registers and regulates them. 2. Insurance company, registered and regulated by the IRDA. 3. Housing finance company, regulated by the National Housing Bank. 4. NI company, regulated by the Ministry of Corporate Affairs under the Companies Act, 1956. 5. Chit Fund company, by respective state governments under Chit Funds Act, 1982. Some of the important regulations relating to acceptance of deposits by the NBFCs are: allowed to accept and or renew public deposits for a minimum period of 12 months and maximum period of 60 months. Cannot accept demand deposits, i.e., the saving and current accounts. Cannot offer interest rates higher than the ceiling rate prescribed by the RBI. Cannot offer gifts, incentives, or any other additional benefit to the depositors. Should have minimum investment grade credit rating. Their deposits are not insured. The repayment of deposits by NBFCs is not guaranteed by RBI. Need to maintain capital adequacy ratio, CAR, norm as prescribed by the RBI. In order to provide with greater operational flexibility to the NBFCs and their enhanced regulation, the RBI announced certain policy changes regarding them. Existing three categories of the NBFCs, asset finance companies, investment companies, and loan companies, were merged into a new category, NBFC investment and credit companies, NBFCs. Now onwards they will be regulated by their activity rather than entity. Deposit-taking NBFC-ICC will invest up to 20% of its net assets in unquoted shares of another company, which is not a subsidiary or a company in the same group of the NBFC. Excluding core investment companies, CICs, the exposures to all of them will be risk-weighted as per credit ratings, similar to corporates. To promote financial inclusion through direct interaction between small lenders and small borrowers together with addressing consumer protection, during 2017-18, RBI introduced two new categories of the NBFC: peer-to-peer, P2P, and account aggregators, AA. As per the Economic Survey 2019-20, after growing very fast in 2017-18, sector decelerated since late 2018-19, hit with scarcity of funds primarily caused by a panic after the Nfs, a big NBFC, defaulted in honoring the payment of its commercial papers, CPS. Since then, the RBI has been trying to ease the liquidity crunch faced by the sector in various ways. By September 2019, the sector accounted for around 18% of the bank assets with a balance sheet size of over 30 lakh crores, maintaining a very safe capital to risk-weighted assets ratio, CRAR, of 19.5%, against the requirement of 15%. Reserve Bank of India. In the wake of the banking crisis of early 20th century, world felt a need of central banking body for the first time. Following the global clue, in India also such a body, the Reserve Bank of India, was set up on April 1, 1935 in accordance with the provisions of the RBI Act, 1934, in Calcutta, got shifted to Bombay in 1937. Set up under private ownership like a bank, it was given two extra functions: regulating banking industry and being the banker of the government. To better serve the purpose, during mid-1940s, a view emerged across the world in favor of a government-owned central bank, and governments started taking them over. In India also, in 1949 the RBI was nationalized. After nationalization it stopped being a bank in technical sense, as it stopped accepting deposits from general public. The RBI has been given quite complex and challenging functions, which has been summarized in its preamble as given below. To regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India, and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of growth. As per the changing needs of time, the RBI Nationalization Act of 1949 has been amended several times by the government and its functions broadened. Its current functions may be summarized objectively in the following way: 1. Monetary authority. It includes formulation, implementation, and monitoring of the monetary policy. The broad objective is maintaining price stability, keeping in mind the objective of growth. Today, under price stability it stabilizes the wholesale price index, WPI, and targets the consumer price index, CPIC. 2. Currency authority. It includes issuing of new currency notes and coins, except the currency and coins of Rupee 1 or its denominations, which are issued by Ministry of Finance itself, as well as exchanging or destroying those ones which are not fit for circulation. This function includes the distribution responsibility of the currencies and coins also, of those ones also which are issued by the Ministry of Finance. The broad objective is keeping adequate supplies of quality currencies and coins. 3. Regulator and supervisor of the financial system. It includes prescribing broad parameters of banking operations within which the banking and financial system operates. The broad objective of this function is maintaining public confidence in the system, protecting depositors' interest and providing cost-effective banking services to the public. 4. Manager of foreign exchange. It includes broad functions like managing the FEMA, Foreign Exchange Management Act, 1999, keeping the forex, foreign exchange, reserves of the country, stabilizing the exchange rate of rupee, and representing the Government of India in the IMF and World Bank, and other international financial agencies of which India is member. Objective of this function is facilitating external trade and external payments, and promoting orderly development or maintenance of foreign exchange market in the country. 5. Regulator and supervisor of payment and settlement systems. It includes functions like introducing and upgrading safe and efficient modes of payment systems in the country to meet the requirements of the public at large. The objective is maintaining public confidence in payment and settlement system. 6. Banker of the governments and banks, known also as the related functions. It includes three categories of functions. Firstly, performing the merchant banking functions for the central and state governments. Secondly, acting as their bankers. And thirdly, maintaining banking accounts of the SCBs, scheduled commercial banks, domestic, foreign, public, and private operating in the country. The broad objectives are enabling governments and the banks mobilize enough liquidity for their functioning, under which it lends or manages borrowing plans of the governments and provides short-term and long-term loans to the banks, as lender of last resort. 7. Developmental functions. Unlike most of the central banks in the world, the RBI was given some developmental functions also. Playing this role, it did set up developmental banks like IDBI, Sdbi, NABARD, NEDB, Northeastern Development Bank, Exim Bank, NHB. Gradually, the ownership of these banks is being transferred from the RBI to the Government of India, aimed at enhancing regulatory freedom and professionalism of the central bank and enabling the government to take care of the dynamic requirements of development in a better way. The RBI operates today with its 27 regional offices, most of them situated in state capitals, and its affairs are governed by a central board of directors. The government constitutes the board by appointing or nominating the directors for a period of 4 years in the following way: 1. Official directors, governor and not more than 4 deputy governors. 2. Non-official directors, 10, nominated from various fields, and 2 government officials. It also includes 4 directors coming one each from the 4 local boards of RBI, also known as sub-offices. They are situated at Chennai, Kolkata, Mumbai, and Delhi. RBI subsidiaries. There are 4 fully owned subsidiaries of the RBI, namely Deposit Insurance and Credit Guarantee Corporation of India, DIC, Bharatiya Reserve Bank Note Mudran Private Limited, BRBNMPL, Reserve Bank Information Technology Private Limited, RBIT, and Indian Financial Technology and Allied Services, IFTAS. New financial year, aimed at aligning its financial year with the government's financial year. In February 2020, the RBI decided to shift to April-March as its new financial year from 2020 to 21, from its existing financial year July-June. Thus, the RBI will do away with nearly 8 decades of practice it used to follow January-December financial year before it was changed to July-June in 1940. Such a change was recommended by the Jalan Committee, set up by the RBI on the Economic Capital Framework, 2019. RBI's reserves and surplus capital. In 2019-20, a lot of debate was seen on the issue of reserve transfer of the RBI to the government. To look into the issue, an expert committee on economic capital framework was set up by the RBI, headed by Bimal Jalan, in 2019, which could advise the manner in which it should share surplus capital with the government. On its advice, the RBI transferred an amount of 1.76 rupees lakh crore to the government and effected several changes related to the issue, giving a clearer distinction between the two components of economic capital: realized equity and revaluation balances. The committee recommended that realized equity could be used for meeting all risks or losses as they were primarily built up from retained earnings, while revaluation balances could be reckoned only as risk buffers against market risks, as they represented unrealized valuation gains and hence were not distributable. The revaluation balance of the central bank should not be distributed. The entire net income can be transferable to the government only if realized equity is above its requirement. If it is below the lower bound of requirement, risk provisioning will be made to the extent necessary and only the residual net income, if any, transferred to the government. On the issue of the RBI's economic capital, the committee reviewed the status, need and justification of the various reserves, risk provisions, and risk buffers maintained by the RBI and recommended their continuance. On the risk provisioning for market risk, the committee has recommended the adoption of expected shortfall (ES) methodology under stressed conditions, in place of the extant stressed value at risk, for measuring the RBI's market risk, on which there was growing consensus among central banks as well as commercial banks over the recent years. While central banks are seen to be adopting ES at 99% or confidence level, CL, the committee has recommended the adoption of a target of ES 99.5% CL, keeping in view the macroeconomic stability requirements. As per the report, realized equity is also required to cover credit risk and operational risk. This risk provisioning, made primarily from retained earnings, is cumulatively referred to as the contingent risk buffer, CRB, and has been recommended to be maintained within a range of 6.5% to 5.5% of the RBI's balance sheet, comprising 5.5 to 4.5% for monetary and financial stability risks and 1.0% for credit and operational risks. The committee based its recommendations on the consideration of the role of central banks' financial resilience, cross-country practices, statutory provisions, and the impact of the RBI's public policy mandate and operating environment on its balance sheet and the risks involved. Monetary policy. Considered as the most dynamic and sensitive function of a central bank, i.e., RBI in case of India, this macroeconomic policy is related to monetary matters chiefly aimed at regulating the size and cost of fund or money in the economic system. From being announced twice a year, before slack and busy seasons, today the policy is a bi-monthly affair announced 6 times in a financial year after the Monetary Policy Committee, MPC, came into being in 2016. Committee-based approach to monetary policy is supposed to add value and transparency to monetary policy with statutory responsibility given to the RBI for targeting inflation, CPIC, while keeping in mind the objective of growth. The MPC has to meet 4 times minimum every year, has a total of 6 members nominated by RBI and the Ministry of Finance in equal numbers, including the RBI Governor as its chairman, who avails the right of casting vote in case of a tie in decisions. The actual tone of the monetary policy stance of RBI is set by its first monetary policy of the year announced beginning every financial year. Gaining its clues form the annual budget announcements. There are few types of monetary policy stances which keep coming into media from time to time. 1. Neutral stance means interest rates may move either way, upward or downward. 2. Calibrated tightening means interest rates can only move upward. 3. Accommodative stance, also known as expansionary stance, means injection of more funds into the financial system. Falling headline inflation inspires RBI for it, and such a stance is aimed at expansion in lending, investment and growth. 4. Contractionary stance means siphoning out of fund from the financial system. Such a stance is generally followed once more than optimum fund is believed to be available in the financial system. At times, it is also aimed at taming inflation in long term. 5. Hawkish stance means the contractionary stance aimed at checking inflation from rising, linked to the statutory goals of inflation targeting the headline inflation. To put in place the desired kind of monetary policy, RBI uses a range of instruments and tools. A brief description follows. Cash reserve ratio. Banks operating in the country are under regulatory obligation to maintain reserve ratios of two kinds, one of it being the cash reserve ratio, the other being statutory liquidity ratio. Under it, all scheduled commercial banks operating in the country are supposed to maintain a part of their total deposits with the RBI in cash form as the cash reserve ratio, CRR. The RBI could fix it between 3 to 15% of the net demand and time liabilities, NDTL, of the banks. In the wake of the ongoing process of banking reforms, certain changes were effected by the RBI in relation to the ratio since late 1990s. 1. Aimed at enabling banks to lend more and cut interest rates on loans they offer. In 1999 to 2000, the RBI started paying banks an interest income on their CRR. The payment of interest was discontinued by late 2007 in the wake of rising prices, to check aggregate demand in the economy. 2. The ratio, which used to be generally on the higher side, was drastically cut down to 4.5% in 2003, from the peak of 15% in 1992. 3. A major development came in 2007 when, by an amendment, in the RBI Act, 1949, the government abolished the lower ceiling, called floor, on the CRR and gave the RBI greater flexibility in fixing this ratio. It means, it is now possible for the RBI to fix the CRR below 3% also. In February 2020, in a first-of-its-kind move, the RBI allowed banks to lend to automobiles, residential housing, and micro, small and medium enterprises, MSMEs, without maintaining the mandatory CRR. This provision will remain open till July 31, 2020. The move is aimed at enhancing lending activity to these sectors which have been hit hard with slowdown in recent times. Simply put, the RBI allowed banks to use the CRR money which otherwise would have been deposited by the banks with the RBI. As a result of this exemption given to banks, the RBI will lose a part of its income since the CRR deposits are used by the RBI in its daily business operations. In March 2020, the CRR was 3% of the NDTL of the bank's. 1% change in it today makes a difference of around 1.37 rupees lakh crore on the cash flow in the financial system. Statutory liquidity ratio. Banks operating in the country are under regulatory obligation to maintain reserve ratios of two kinds, one of it being the statutory liquidity ratio, the other being the cash reserve ratio. Under it, all scheduled commercial banks operating in the country are supposed to maintain a part of their total deposits, i.e., their NDTL, with themselves in non-cash form, i.e., in liquid assets. The ratio could be fixed by the RBI between 25 to 40%. In practice, banks cannot invest this fund in the liquid assets of their choice, rather they are forced to invest in the government securities, i.e., GSECS, of various kinds. Banks earn income on this investment as per the configuration of their investments in the GSECS. In the wake of the ongoing process of banking reforms, certain changes were effected by the RBI in relation to the ratio since late 1990s. 1. The ratio was drastically cut down to 25%, the floor, in 1997 from the existing level of 32%. 2. By an amendment, in the RBI Act, 1949, done in 2007, the lower ceiling, the floor, of 25% was removed by the government. This way, the SLR may be fixed by the RBI below 25% also. Since then the SLR have shown a falling tendency. In March 2020, the SLR was at 18.25% of the NDTL of the banks. With 1% change in this ratio today, banks either lose or gain choice of investing around a fund of 1.37 rupees lakh crores. Bank rate. The interest rate which the RBI charges on its long-term lendings is known as the bank rate. The clients who borrow through this route are the Government of India, state governments, banks, financial institutions, cooperative banks, Nbfcs, etc. The rate has direct impact on long-term lending activities of the concerned lending bodies operating in the Indian financial system. The rate was realigned with the MSF, Marginal Standing Facility, by the RBI in February 2012. By March 2020, it was at 4.65%. Repo rate. The rate of interest the RBI charges from its clients on their short-term borrowing is the repo rate in India. Basically, this is an abbreviated form of the rate of repurchase, and in Western economies it is known as the rate of discount. In practice it is not called an interest rate but considered a discount on the dated government securities, which are deposited by institution to borrow for the short term. When they get their securities released from the RBI, the value of the securities is lost by the amount of the current repo rate. The call money market of India, interbank market, operates at this rate, and banks use this route for overnight borrowings. This rate has direct relation with the interest rates banks charge on the loans they offer, as it affects the operational cost of the banks. The rate was 4.40% in March 2020. In October 2013, RBI introduced term repos, of different tenors, such as 7 or 14 or 28 days, to inject liquidity over a period that is longer than overnight. It has several purposes to serve stronger money market stability and better costing and signaling of the loan products. Long-term repo. Aimed at promoting enhanced lending and cutting the cost of short-term funds for the banks, in a first-of-its-kind move, in February 2020, sixth bi-monthly monetary policy of 2019-20, the RBI announced to offer long-term repo operation, LTRO, of 1.50 rupees lakh crores at a fixed rate, i.e., at the repo rate. The tenure of the LTRO will be from 1 to 3 years. This was aimed at ensuring permanent and deeper liquidity in the financial system, together with enhancing lending by cutting cost of funds for the banks, enabling them to lend cheaper loans. Reverse repo rate. It is the rate of interest the RBI pays to its clients who offer short-term loan to it. At present, March 2020, the rate is at 4.00%. It is reverse of the repo rate, and this was started in November 1996 as part of Liquidity Adjustment Facility, LAF, by the RBI. In practice, financial institutions operating in India park their surplus funds with the RBI for short-term period and earn money. It has a direct bearing on the interest rates charged by the banks and the financial institutions on their different forms of loans. This tool was utilized by the RBI in the wake of over-money supply with the Indian banks and lower loan dispersal to serve twin purposes of cutting down banks' losses and the prevailing interest rate. It has emerged as a very important tool in direction of following cheap interest regime, the general policy of the RBI since reform process started. Marginal Standing Facility, MSF. MSF is a new scheme announced by the RBI in its monetary policy, 2011-12, which came into effect from May, 2011. Under this scheme, banks can borrow overnight up to 1% of their net demand and time liabilities, NDTL, from the RBI, at the interest rate 1%, 100 basis points, higher than the current repo rate. In an attempt to strengthen rupee and checking its falling exchange rate, the RBI increased the gap between repo and MSF to 3%, late July 2013. The MSF rate has been floated as a penal rate, and since mid-2015 RBI has maintained it 1% or higher than the prevailing repo rate. By end March 2020 it is at 4.65%, fully aligned with the bank rate, i.e., equal to the bank rate. Other tools. Other than the above given instruments, RBI uses some other important, to activate the right kind of the credit and monetary policy. 1. Call money market. The call money market is an important segment of the money market where borrowing and lending of funds take place on overnight basis. Participants in the call money market in India currently include scheduled commercial banks, SCBs, excluding regional rural banks, cooperative banks, other than land development banks, insurance. Prudential limits, in respect of both outstanding borrowing and lending transactions in the call money market for each of these entities, are specified by the RBI. In recent times, several changes have been introduced by the RBI in this market. By April 2016, banks were allowed to borrow only 1% of their NDTL, net demand and time liabilities, i.e., total deposit of the banks, in layman term, under overnight facility at repo rate. For the rest of 0.75% of their NDTL, they may use the term repos of different tenors. In a sense, since late 2013, RBI has been discouraging banks to use repo route and switch over to term repos for their requirements of the short-term funds. Promoting stability and signaling better cost of loans are the main objectives of this changed stance. 2. Open market operations, OMOs. OMOs are conducted by the RBI via the sale or purchase of government securities, GSEC, to or from the market with the primary aim of modulating rupee liquidity conditions in the market. OMOs are an effective quantitative policy tool in the armory of the RBI, but are constrained by the stock of government securities available with it at a point in time. Other than the institutions, now individuals will also be able to participate in this market. The decision was taken in 2017 while it is yet to be implemented. 3. Liquidity Adjustment Facility, LAF. The LAF is the key element in the monetary policy operating framework of the RBI, introduced in June 2000. On daily basis, the RBI stands ready to lend to or borrow money from the banking system, as per the need of the time, at fixed interest rates, repo and reverse repo rates. Together with moderating the fund mismatches of the banks, LAF operations help the RBI to effectively transmit interest rate signals to the market. The recent changes regarding a cap on the repo borrowing and provision of the term repo have changed the very dynamics of this facility after 2013. 4. Market Stabilization Scheme, MSS. This instrument for monetary management was introduced in 2004. Surplus liquidity of a more enduring nature arising from large capital inflows is absorbed through sale of short-dated government securities and treasury bills. The mobilized cash is held in a separate government account with the Reserve Bank. The instrument thus has features of both SLR and CRR. 5. Standing Deposit Facility Scheme, SDFS. The new scheme has been proposed by the Union Budget 2018-19. Such a tool was proposed by the RBI in November 2015 itself. The scheme is aimed at helping RBI to manage liquidity in a better way, especially when the economy is flush with excess fund, as was seen after the demonetization of the high-value currency notes post-November 2016. Base rate. Base rate is the interest rate below which scheduled commercial banks, SCBs, will lend no loans to its customers. It means it is like prime lending rate, PLR, and the benchmark prime lending rate, BPLR, of the past and is basically a floor rate of interest. It replaced the existing idea of BPLR on July 1, 2010. The BPLR system, while the existing system was of PLR, introduced in 2003, fell short of its original objective of bringing transparency to lending rates. This was mainly because under the system, banks could lend below BPLR. This made a bargaining by the borrower with bank, ultimately one borrower getting cheaper loan than the other, and blurred the attempts of bringing in transparency in the lending business. For the same reason, it was also difficult to assess the transmission of policy rates, i.e., repo rate, reverse repo rate, bank rate, of the Reserve Bank to lending rates of banks. The base rate system is aimed at enhancing transparency in lending rates of banks and enabling better assessment of transmission of monetary policy. After its deregulation by the RBI in 2010, banks fix their own base rates. Thus, in practice, base rate shows differentiation changing from bank to bank according to differentiation in the operational costs of the banks. Banks were not allowed to lend any loan below their base rates. In March 2020, the base rate of the banks was in the range of 8.15 to 9.40%. By the fiscal 2015-16, several new initiatives were taken by the RBI in the area of credit and monetary policy management. Major ones are being given below: transition to a bi-monthly monetary policy cycle, recognition of the glide path for disinflation, recommendation of Urjit Patel Committee report implemented. Under it, the CPI-C is used by the RBI as the headline inflation for monetary management. A monetary policy framework has been put in place. An agreement in this regard was signed between the Government of India and the RBI late February 2015. Under the framework, the RBI is to target inflation at 4% or with the variations of 2%. It means, the range of inflation is to be between 2 to 6% of the CPIC. Besides the existing repo route, term repos have been introduced for 3 set of tenors: 7, 14, and 28 days. RBI is progressively reducing banks' access to overnight liquidity, at the fixed repo rate, and encouraging the banks to increase their dependency on the term repos. By March 2016, banks were allowed to borrow only up to 1% of their NDTL from the call money market, 0.25% through repo, and the rest of 0.75% through term repo. This aims to improve the transmission of policy impulses across the interest rate spectrum and providing stability to the loan market. In 2016-17, individuals were also allowed by the RBI to participate in the government security market, similar to the developed economies like the USA. MCLR. From the financial year 2016-17, i.e., from April 1, 2016, banks in the country have shifted to a new methodology to compute their lending rate. The new methodology, MCLR, marginal cost of funds-based lending rate, which was articulated by the RBI in December 2015. The main features of the MCLR are: it will be a tenor-linked internal benchmark, to be reset on annual basis. Actual lending rates will be fixed by adding a spread to the MCLR, to be reviewed every month on a pre-announced date. Existing borrowers will have the option to move to it. Banks will continue to review and publish base rate as hitherto. As per the RBI, for monetary transmission to occur, lending rates have to be sensitive to the policy rate. But this was not occurring by now. During 2015-16, the RBI reduced the policy rate, repo rate, by a total of 1.25%. But in comparison, banks reduced the lending rate by maximum 0.6%. By now, banks have been using either of the following 3 methods to compute their base rate: 1 average cost of funds, 2 marginal cost of funds, or 3 blended cost of funds, liabilities. As per the RBI, the MCLR will bring in the following benefits: transmission of policy rate into the lending rates of banks to improve, computation of the interest rates by banks will get more transparent, cost of loan will be fairer to the borrowers as well as the banks. It will help the banks to become more competitive and enhance their long-run value. By late March 2020, the MCLRs of banks were in the range of 7.40 to 7.90%. As the idea of the MCLR did not bring in the desired results, i.e., the healthy monetary transmission, RBI announced, in its 5th bi-monthly monetary policy statement of December 2018, that from April 2019 all new floating loans extended by banks will be benchmarked, i.e., linked to one of the following 4 RBI prescribed external benchmarks: 1 repo rate, 2 91-day Treasury bill yield, 3 182-day Treasury bill yield, 4 any other benchmark produced by the FBIL, Financial Benchmarks India Private Ltd.
It means that the actual lending rates will not remain linked to the internal data of the banks. Banks, as the case has been for MCLR, and banks will be forced to link the interest rates of their new loans with an external and market-determined benchmark. After a short delay, banks started switching over to the external benchmarks from October 2019. Meanwhile, the process has not resulted into a much better monetary transmission.
Monetary transmission. Monetary policy plays a very vital role in the allocation of funds from the financial system. For this, lending rates decided by the banks must be sensitive to the policy rates, i.e., repo, reverse repo, MSF, and bank rate, announced by the central bank, known as monetary transmission. But in recent years, a healthy monetary transmission has been lacking in the system. Since 2015 to 16 itself, the RBI has been concerned about a general lack of monetary transmission in the financial system. Till April 2020, steps like enforcing the MCLR and external benchmarks on banks for deciding their lending rates have been taken by the RBI. But monetary transmission has been weak in 2019 also on all three accounts, namely rate structure, quantity of credit, and term structure.
Rate structure. The weighted average lending rate, WAL, of scheduled commercial banks, SCBs, has not declined at all in 2019 despite reduction of repo rate by 1.35%. For outstanding loans it was at 10.40% in October 2019. In January 2019, it was 10.38%. In case of fresh loans, the monetary transmission has been slightly better. While Psb'S cut interest by 0.47%, private sector by 0.40% between January and October 2019. The credit spread, difference between repo rate and WAL, was at the highest level in this decade. The WAL on outstanding loans of SCBs is 5.25% higher than the repo rate. This suggests that there has been no transmission of the cut in repo rate to lending rates of the banks in 2019. Between January to October 2019, the growth rate of the saving deposit as well as term deposit both fell by 0.25% and 0.16% respectively. An important limiting factor seems to be the rate on small savings scheme like Public Provident Fund, PPF. At the end of October 2019, the interest offered on the PPF was 1.15% higher than the weighted average term deposit rate, WATER, while there was no gap in 2014. Without taking care of the interest offered on small saving schemes, it seems difficult to encourage term deposit growth. Term structure, cut in the policy rate, had some impact on the short-term interest rates. On 364-day Treasury bill it fell to 5.3% by 14th January 2020, from 6.3% of 1st April 2019. But in case of long-term securities the interest rate decline was very small. On the 10-year G-Sec it fell only to 6.6% by 14th January 2020, from 7.2% of 1st April 2019. To induce a fall in the interest rate on the long-term fund, the RBI in December 2019 decided to purchase long-term G-Sec of 10,000 crore rupees maturing in 2029 and sell short-term G-Sec of equal amount maturing in 2020, referred by the experts as Operation Twist of the RBI. Following this action, interest rate on 10-year government bond fell by over 0.35% till February 2020. Credit growth. The credit growth in the economy has been declining in 2019 to 20, despite a decrease in policy rates. By 20th December 2019 it was at 7.1% in comparison to 12.9% of April 2019. The fall in credit growth was led by services sector and micro, small and medium enterprises, MSMEs. The MSMEs saw a negative credit growth rate during the period. Liquidity Management Framework. A liquidity management framework, LMF, was provisioned by the RBI in 2014 to check volatility in the interbank call money market, CMM, and allow banks manage their needs of short-term capital. As per the last revision done by the RBI in February 2020, the LMF guidelines were as given below. The combined repo borrowings of all banks put together on a day cannot be more than 1% of the combined NDTL of the banks, known as the upper ceiling on repo borrowing. Individual banks can borrow not more than 1% of their NDTL under repo operation, 0.25% of it as overnight repo, and rest of the 0.75% as term repo for 7 or 14 or 28 days. After exhausting the option of the various repos, banks can borrow up to 1% of their NDTL directly from the RBI for 1 day, called overnight, under the Marginal Standing Facility, MSF. The long-term repo started by the RBI in February 2020 is an extra window over and above the 1% upper cap on the repo operation. In a push to bring in more stability and better interest rate signaling in the loan market, the RBI has been trying to inspire banks to think in longer term in their operations. Aimed at making banks follow prudential norms, the Basel Ii norms also has put a clear check on short-termism followed by banking industry. Nationalization and development of banking in India. The development of banking industry in India has been intertwined with the story of its nationalization. Once the Reserve Bank of India, RBI, was nationalized in 1949 and a central banking was in place, the government considered the nationalizing of selected private banks in the country due to the following major reasons. 1. As the banks were owned and managed by the private sector, the services of the banking were having a narrow reach. The masses had no access to the banking service. 2. The government needed to direct the resources in such a way that greater public benefit could take place. 3. The planned development of the economy required a certain degree of government control on the capital generated by the economy. Nationalization of banks in India took place in the following stages. Emergence of the SBI. The Government of India, with the enactment of the SBI Act, 1955 partially nationalized the 3 imperial banks, mainly operating in the 3 past presidencies with their 466 branches, and named them the State Bank of India, the first public sector bank emerged in India. The RBI had purchased 92% of the shares in this partial nationalization. Satisfied with the experiment, the government in a related move partially nationalized 8 more private banks with good regional presence via the SBI Associates Act 1959 and named them as the Associates of the SBI. The RBI had acquired 92% stake in them as well. Later on, the State Bank of Bikaner and Jaipur was created by merging the State Bank of Jaipur and State Bank of Bikaner, as they used to operate in the same region. Following the banking consolidation process, by 2017 to 18 the SBI and its associates, 7+1, were amalgamated into one bank, the SBI. Emergence of nationalized banks. After successful experimentation in the partial nationalizations, the government decided to go for complete nationalization. With the help of the Banking Nationalization Act, 1969, the government nationalized a total number of 20 private banks. 1. 14 banks with deposits were more than 50 crore rupees of nationalized in July 1969, and 2. 6 banks with deposits were more than 200 crore rupees of nationalized in April 1980. After the merger of the loss-making New Bank of India with the Punjab National Bank, PNB, in September 1993, the total number of nationalized banks came down to 19. By April 2020, there were 18 public sector banks, Psb'S, in India. Aimed at streamlining their operation and size, the government started a process of merger and amalgamation of the Psb'S in 2020. After the completion of this process, the number of the Psb'S will be reduced to only 12. After the nationalization of banks, the government stopped opening of banks in the private sector, though some foreign private banks were allowed to operate in the country to provide the external currency loans. After India ushered in the era of the economic reforms, the government started a comprehensive banking system reform in the fiscal 1992-93. Three related developments allowed the further expansion of banking industry in the country. 1. In 1993, the SBI was allowed access to the capital market with permission given to sell its share to the tune of 33% through SBI Amendment Act 1993. At present, the Government of India has 59.73% shares in the SBI. It was on 9th July 2007 that the entire equity stake of the RBI was taken over by the Government of India. Thus, the RBI is no more the holding bank of the SBI and its associates. On 10th October 2007, the government announced its proposal of selling the shares of the SBI and cutting down its stake in it to 53% level so that the bank can go for capitalization. 2. In 1994, the government allowed the nationalized banks to have access to the capital market with a ceiling of 33% sale of shares through the Banking Companies Amendment Act 1994. Since then, many nationalized banks have tapped the capital market for their capital enhancement, Indian Overseas Bank being the first in the row. Though such banks could be better called the public sector banks, as the Government of India holds more than 50% stake in them, they are still known as the nationalized banks. 3. In 1994 itself, the government allowed the opening of private banks in the country. The first private bank of the reform era was the UTI Bank. Since then, a few dozens Indian and foreign private banks have been opened in the country. Thus, since 1993 to 94 onwards, we see a reversal of the policies governing banks in the country. As a general principle, the public sector and the nationalized banks are to be converted into private sector entities. What would be the minimum government holding in them is still a matter of debate and yet to be decided. The policy of bank consolidation is still being followed by the government, so that these banks could broaden their capital base and emerge as significant players in the global banking competition. Every delay in it will hamper their interests, as per the experts. Regional Rural Banks, RRBs. The Regional Rural Banks, RRBs, were first set up on 2nd October 1975, only 5 in numbers, with the aim to take banking services to the doorsteps of the rural masses, especially in the remote areas with no access to banking services, with twin duties to fulfill: 1. To provide credit to the weaker sections of the society at concessional rate of interest who previously depended on private money lending, and 2. To mobilize rural savings and channelize them for supporting productive activities in the rural areas. The GOI, the concerned state government, and the sponsoring nationalized bank contribute the share capital of the RRBs in the proportion of 50%, 15%, and 35%, respectively. The area of operation of the RRB is limited to notified few districts in a state. Following the suggestions of the Kelkar Committee, The government stopped opening new RRBs in 1987. By that time their total number stood at 196. Due to excessive leanings towards social banking and catering to the highly economically weaker sections, these banks started incurring huge losses by early 1980s. For restructuring and strengthening of the banks, the government set up two committees, the Bhandari Committee, 1994-95, and the Basu Committee, 1995-96. Out of the total, 171 were running in losses in 1998-99 when the government took some serious decisions. 1. The obligation of concessional loans abolished, and the RRBs started charging commercial interest rates on its lendings. 2. The target clientele, rural masses, weaker sections, was set free now to lend to anybody. After the above-given policy changes, the RRBs started coming out of the red or losses. The CFS has recommended to get them merged with their managing nationalized or public sector banks and finally make them part of the would-be three-tier banking structure of India. By April 2020, as per the RBI, there were 53 RRBs operating in the country. Over 13 of them were under the process of amalgamation with their parent Psb'S, in coming times to be fully replaced by the small banks. Cooperative Banks. Banks in India can be broadly classified under two heads, commercial banks and cooperative banks. While commercial banks, nationalized banks, state bank group, private sector banks, foreign banks and regional rural banks account for an overwhelming share of the banking business, cooperative banks also play an important role. Initially set up to supplant indigenous sources of rural credit, particularly money lenders, today they mostly serve the needs of agriculture and allied activities, rural-based industries, and to a lesser extent, trade and industry in urban centers. Cooperative banks have a three-tier structure. 1. Primary Credit Societies PCSs, agriculture or urban. 2. District Central Cooperative Banks DCCBs, and 3. State Cooperative Banks SCBC, at the apex level. UCBs, Primary Credit Societies, PCSs, in urban areas that meet certain specified criteria can apply to RBI for a banking license to operate as urban cooperative banks, UCBs. They are registered and governed under the Cooperative Societies Acts of the respective states and are covered by the Banking Regulation Act, 1949, thus are under dual regulatory control. The managerial aspects of these banks, registration, management, administration, recruitment, amalgamation, liquidation, etc. are controlled by the state governments, while the matters related to banking are regulated by RBI. Traditionally, the area of operation of the UCBs is confined to metropolitan, urban or semi-urban centers and caters to the needs of small borrowers including MSMEs, retail traders, small entrepreneurs, professionals and the salaried class. However, there is no formal restriction as such and today UCBs can conduct business in the entire district in which they are registered, including rural areas. Well-managed primary UCBs with deposits of over 50 crore rupees are also allowed to operate in more than one state subject to certain norms. As they are covered by the RBI Act, 1934, Second Schedule, they have certain rights and obligations, rights of obtaining refinance and loans from the RBI and obligations such as maintenance of cash reserves, submission of returns to the RBI, etc. Presently, there are 29 UCBs. DCCBs and SCBs, as their names suggest, they operate at the district and state levels. One district can have no more than one DCCB, with a number of DCCBs reporting to the SCB. They were under supervision of the RBI. Later on, this function was delegated to the NBFCs. Problems of these banks. Cooperative banks play a very vital role in India's financial system. They have been faced with certain long-drawn problems also. We may have brief look them. Regulation remains the biggest issue as they are under dual regulatory control. The UCBs come under the RBI and the Registrar of Cooperative Societies, RCS, of the respective states, while the DCCBs and SCBs come under the NBFCs, the RBI, and the RCSs. Given the close links between politicians and cooperatives, and the fact that the RCS functions under the state government, in practice this dual or triple custody of the cooperative banks has, in practice, led to poor supervision and control. Besides, most cooperative banks are lacking in skill and expertise. Recruitments are politicized, as are appointments at most levels. Income recognition and prudential norms that were introduced for commercial banks in the early 1990s under the process of banking reforms are still to be this sector. Cooperative banks have been in news mostly for fraudulent deals. Due to multiplicity of regulatory control of the federal nature, it becomes really difficult to comply these banks to the prudential norms. Meanwhile, the Government of India decided, in the Union Budget 2017-18, to bring the cooperative banks into the ambit of the core banking structure. Under the core banking solution, CBAs, customers are able to avail banks' services across all of the branches rather the branch where the account is, making them customers of the bank rather than of a branch. To provide more powers to the RBI to regulate cooperative banks, a bill, Banking Regulation Amendment Bill, 2020, was introduced by the government in the Parliament in March 2020. The initiative came in the backdrop of the PMC bank scam, which seeks to strengthen cooperative banks by increasing professionalism, enabling access to capital, improving governance, and ensuring sound banking through the RBI. Financial sector reforms. The process of economic reforms initiated in 1991 had redefined the role of government in the economy. In coming times, the economy will be dependent on the greater private participation for its development. Such a changed view to development required an overhauling in the investment structure of the economy. Now the private sector was going to demand high investable capital out of the financial system. Thus, an emergent need was felt to restructure the whole financial system of India. The 3 decades after nationalization had seen a phenomenal expansion in the geographical coverage and financial spread of the banking system in the country. As certain weaknesses were found to have developed in the system during the late 80s, it was felt that these had to be addressed to enable the financial system to play its role ushering in a more efficient and competitive economy. Accordingly, a high-level committee on financial system, CFS, was set up on 14 August 1991 to examine all aspects relating to structure, organization, function and procedures of the financial system. Based on its recommendations, a comprehensive reform of the banking system was introduced in the fiscal 1992-93. The CFS based its recommendations on certain assumptions which are basic to the banking industry. And the suggestions of the committee became logical in light of this assumption. There is no second opinion about it. The assumption says that the resources of the banks come from the general public and are held by the banks in trust, that they are to be deployed for maximum benefit of the depositors. This assumption automatically implied, 1. That even the government had no business to endanger the solvency, health and efficiency of the nationalized banks under the pretext of using banks' resources for economic planning, social banking, poverty alleviation, etc. 2. Besides, the government had no right to get hold of the funds of the banks at low interest rates and use them for financing its consumption expenditure, i.e., revenue and fiscal deficits, and thus defraud the depositors. The recommendations of the CFS, Narasimham Committee I, were aimed at 1. Ensuring a degree of operational flexibility, 2. Internal autonomy for public sector banks, Psb'S, in their decision-making process, and 3. Greater degree of professionalism in banking operation. Recommendation of CFS. The CFS recommendation could be summed up under 5 subtitles. 1. On directed investment, the RBI was advised not to use the CRR as a principal instrument of monetary and credit control. In place, it should rely on open market operations, OMOs, increasingly. 2. Proposals advised regarding the CRR. 1. CRR should be progressively reduced from the present high level of 15% to 3 to 5%. And 2. RBI should pay interest on the CRR of banks above the basic minimum at a rate of interest equal to the level of banks' 1-year deposit. Concerning the SLR, it was advised to cut it to the minimum level, i.e., 25%, from the present high level of 38.5% in the next 5 years. It was cut down to 25% in October 1997. The government was also suggested to progressively move towards market-based borrowing program so that banks get economic benefits on their SLR investments. These suggestions were directed to the goal of making more funds available to the banks, converting idle cash for use, and cutting down the interest rates banks charge on their loans. 2. On directed credit program. Under this subtitle, the suggestions revolved around the compulsion of priority sector lending, PSL, by the banks. 1. Directed credit program should be phased out gradually. As per the committee, agriculture and small-scale industries, SSIs, had already grown to a mature stage and they did not require any special support. 2 decades of interest subsidy were enough. Therefore, concessional rates of interest could be dispensed with. 2. Directed credit should not be a regular program. It should be a case of extraordinary support to certain weak sections. Besides, it should be temporary, not a permanent one. 3. Concept of PSL should be redefined to include only the weakest sections of the rural community such as marginal farmers, rural artisans, village and cottage industries, tiny sector, etc. 4. The redefined PSL should have 10% fixed of the aggregate bank credit. 5. The composition of the PSL should be reviewed after every 3 years. 3. On the structure of interest rates. The major recommendations on the structure of interest rates are 1. Interest rates to be broadly determined by market forces. 2. All controls of interest rates on deposits and lending to be withdrawn. 3. Concessional rates of interest for PSL of small sizes to be phased out and subsidies on the IRDP loans to be withdrawn. 4. Bank rate to be the anchor rate and all other interest rates to be closely linked to it. And 5. The RBI to be the sole authority to simplify the structure of interest rates. 4. On structural reorganization of the bank. For the structural reorganization of banks, some major suggestions were given. 1. Substantial reduction in the number of the Psb'S through mergers and acquisitions to bring about greater efficiency in banking operations. 2. Dual control of RBI and banking division of the Ministry of Finance should go immediately and RBI to be made the primary agency for the regulation of the banking system. 3. The Psb'S to be made free and autonomous. 4. the RBI to examine all the guidelines and directions issued to the banking system in the context of the independence and autonomy of the banks. 5. Every PSB to go for a radical change in work technology and culture, so as to become competitive internally and to be at par with the wide range of innovations taking place abroad. And 6. Finally, the appointment of the Chief Executive of Bank, CMD, was suggested not to be on political considerations but on professionalism and integrity. An independent panel of experts was suggested which should recommend and finalize the suitable candidates for this post. 5. Asset reconstruction companies or fund to tackle the menace of the higher non-performing assets, NPAs, of banks and financial institutions. The committee suggested setting up of asset reconstruction companies or funds, taking clue from the US experience. The committee directly blamed the Government of India and the Ministry of Finance for the sad state of affairs of the Psb'S. These banks were used and abused by the GOI, the officials, the bank employees and the trade unions, the report adds. The recommendations were revolutionary in many respects and were opposed by the bank unions and the leftist political parties. There were some other major suggestions of the committee, which made it possible to get the following things done by the government. 1. Opening of new private sector banks permitted in 1993. 2. Prudential norms relating to income recognition, asset classification and provisioning by banks on the basis of objective criteria laid down by the RBI. 3. Introduction of capital adequacy norms, i.e., CAR provisions, with international standards started. 4. Simplification in the banking regulation, i.e., via Board for Financial Supervision in 1994, etc. Banking sector reforms. The government commenced a comprehensive reform process in the financial system in 1992-93 after the recommendations of the CFS in 1991. In December 1997, the government did set up another committee on the banking sector reform under the chairmanship of Narasimham. The objective of the committee is objectively clear by the terms of reference it was given while setting up. To review the progress of banking sector reforms to date and chart a program of financial sector reforms necessary to strengthen India's financial system and make it internationally competitive. The Narasimham Committee, too, popularly called by the Government of India, handed over its reports in April 1998, which included the following major suggestions. 1. Need for a stronger banking system for which mergers of the PSBs and the financial institutions, AIFIs, were suggested. Stronger banks and the DFIs, development financial institutions, i.e., AIFIs, to be merged while weaker and unviable ones to be closed. 2. A three-tier banking structure was suggested after mergers. A. Tier 1 to have 2 to 3 banks of international orientation. B. Tier 2 to have 8 to 10 banks of national orientation. And C. Tier 3 to have large number of local banks. The first and second tiers were to take care of the banking needs of the corporate sector in the economy. 3. Higher norms of capital to risk, weighted adequacy ratio, CRAR, suggested, increased to 10%. 4. Budgetary recapitalization of the PSBs is not viable and should be abandoned. 5. Legal framework of loan recovery should be strengthened. The government passed the SARFAESI Act 2002. 6. Net NPAs for all banks suggested to be cut down to below 5% by 2003% by 2002. 7. Rationalization of branches and staffs of the PSBs suggested. 8. Licensing to new private banks, domestic as well as foreign, was suggested to continue with. 9. Banks boards should be depoliticized under RBI supervision. 10. Board for Financial Regulation and Supervisions, BFRS, should be set up for the whole banking, financial, and the NBFCs in India. DRI. The Differential Rate of Interest, DRI, is a lending program launched by the government in April 1972 which makes it obligatory upon all the public sector banks in India to lend 1% of the total lending of the preceding year to the poorest of the poor at an interest rate of 4% per annum. Priority Sector Lending. All Indian banks have to follow the compulsory target of Priority Sector Lending, PSL. The priority sector in India are at present the sectors agriculture, small and medium enterprises, SMEs, road and water transport, retail trade, small business, small housing loans, not more than 10 lakhs rupees, software industries, self-help groups, SHEs, agro-processing, small and marginal farmers, artisans, distressed urban poor and indebted non-institutional debtors besides the SCs, STs and other weaker sections of society. In 2007, the RBI included 5 minorities, Buddhists, Christians, Muslims, Parsis and Sikhs under the PSL. In its new guidelines of March 2015, the RBI added medium enterprise, sanitation and renewable energy under it. The PSL target must be met by the banks operating in India in the following way. 1. Indian banks need to lend 40% to the priority sector every year, public sector as well as private sector banks, both, of their total lending. There is a sub-target also. 18% of the total lending must go to agriculture, and 10% of the total lending or 25% of the priority sector lending, whichever be higher, must be lent out to the weaker sections. Other areas of the priority sector to be covered in the left amount, i.e., 12% of the total lending. 2. Foreign banks, having less than 20 branches, have to fulfill only 32% PSL target which has sub-targets for the exports, 12%, and small and medium enterprises, 10%. It means they need to disburse other areas of the PSL from the remaining 10% of their total lending, lesser burden. The Committee on Financial System, CFS, 1991, had suggested to immediately cut it down to 10% for all banks and completely phasing out of this policy for the betterment of the banking industry in particular and the economy in general. The committee also suggested to shuffle the sectors covered under PSL every 3 years. No follow-up has been done from the government except cutting down PSL target for the foreign banks from 40% to 32%, remaining same for those which have less than 20 branches. Meanwhile, some new areas have been added to the PSL. NPAs and stressed assets. Non-performing assets, NPAs, are the bad loans of the banks. The criteria to identify such assets have been changing over the time. In order to follow international best practices and to ensure greater transparency, the RBI shifted to the current policy in 2004. Under it, a loan is considered NPA if it has not been serviced for one term, i.e., 90 days. This is known as 90-day overdue non. For agriculture loans, the period is tied with the period of the concerned crops, ranging from 2 crop seasons to 1 year overdue non. NPAs were classified into 3 types: 1. Substandard, remaining NPAs for less than or equal to 12 months, 2. Doubtful, remaining NPAs for more than 12 months, and 3. Loss assets, where the loss has been identified by the bank or internal or external auditors or the RBI inspection, but the amount has not been written off. Recent upsurge. During 2019 to 20, the performance of the banking sector, public sector banks, Psb'S, in particular, continued to be subdued. As per the Economic Survey 2019 to 2020, the gross NPA ratio of SCBs remained unchanged at 9.1% between March and September 2019. The size of the net NPAs has remained sticky at around 12.2% for the SCBs. The public sector banks have been hit with the NPS crisis at the maximum, which has hit the general credit expansion in the economy. However, through the insolvency proceedings, banks have been able to recover around 1.58 lakh rupees crore by December 2019. But haircuts in the valuation of the assets have been also very high. Though, various reasons, as reported by the government documents since 2013 to 14, have been cited for the recent upsurge in the NPAs of the Psb'S. By now the major ones are being considered as given below. 1. Global and domestic macroeconomic instabilities, due to which a slowdown was seen in the economy, diluting the capability of the borrowers to service the loans. 2. Delays in project approvals resulting into high cost overruns. This dented the loan servicing capability of the borrowers in a big way. 3. Aggressive lending by the banks to high corporate leverage. 4. High incidences of willful defaults. 5. Cases of loan frauds. 6. Instances of corruption in the banking institutions. Now, the government has commenced a multi-pronged policy framework to resolve the NPA crisis faced by the public sector banks. Resolution of the NPAs. At one hand, while the RBI tried to check the NPAs from rising by announcing new guidelines for the banks, on the other hand, it has also taken several steps to resolve the problem. By February 2017, since 2014 to 15, the RBI has implemented a number of schemes to facilitate resolution of the NPAs problem of the banks, briefly discussed below. 5/25 refinancing. This scheme offered a larger window for revival of stressed assets in the infrastructure sectors and 8 core industries. Under this scheme, lenders were allowed to extend the tenure of loans to 25 years with interest rates adjusted every 5 years, so tenure of the loans matches the long gestation period in the sectors. The scheme thus aimed to improve the credit profile and liquidity position of borrowers, while allowing banks to treat these loans as standard in their balance sheets, reducing provisioning costs against NPAs. However, with amortization spread out over a longer period, this arrangement also meant that the companies faced a higher interest burden, which they found difficult to repay, forcing banks to extend additional loans, called evergreening. This in turn has aggravated the initial problem. ARCs, Asset Reconstruction Companies, ARCs were introduced to India under the SARFAESI Act, 2002, as specialists to resolve the burden of NPAs. But the ARCs, most are privately owned, finding it difficult to resolve the NPAs they purchased, are today only willing to purchase such loans at low prices. As a result, banks have been unwilling to sell them loans on a large scale. Since 2014, the fee structure of the ARCs was modified, requiring ARCs to pay a greater proportion of the purchase price upfront in cash to the banks. Purchases of NPAs by them have slowed down further. Only about 5% of total NPAs were sold during 2014 to 15 and 2015 to 16. SDR, Strategic Debt Restructuring. In June 2015, RBI came up with the SDR scheme, provide an opportunity to banks to convert debt of companies whose stressed assets were restructured but which could not finally fulfill the conditions attached to such restructuring, to 51% equity and sell them to the highest bidders, ownership change takes place in it. By end December 2016, only two such sales had materialized, in part because many firms remained financially unviable, since only a small portion of their debt had been converted to equity. AQR, Asset Quality Review. Resolution of the problem of bad assets requires sound recognition of such assets. Therefore, the RBI emphasized AQR to verify that banks were assessing loans in line with RBI loan classification rules. Any deviations from such rules were to be rectified by March 2016. S4A, Scheme for Sustainable Structuring of Stressed Assets, introduced in June 2016. In it, an independent agency is hired by the banks which decides as how much of the stressed debt of a company is sustainable. The rest, unsustainable, is converted into equity and preference shares. Unlike the SDR arrangement, this involves no change in the ownership of the company. Public Sector Asset Rehabilitation Agency, PARA. To resolve the twin problems of balance sheet syndrome of the banks as well as the corporate sector, the Economic Survey 2016-17 has suggested the government to set up a Public Sector Asset Rehabilitation Agency, PARA, charged with the largest and most complex cases of the syndrome. Such initiatives were successfully able to handle the twin balance sheet (TBS) problems in the countries hit by the Southeast currency crisis of mid-1990s. As per the survey, the agency charged with working out the largest and most complex cases. Such an approach could eliminate most of the obstacles currently plaguing loan resolution. Coordination problem, as in this case, the debts would be centralized in one agency. It could be set up with proper incentives by giving it an explicit mandate to maximize recoveries within a defined time period, and it would separate the loan resolution process from concerns about bank capital. The survey has outlined 7 reasons in support of its suggestion for setting up the PARA, which are as given below. 1. It's not just about banks, it's a lot about companies. So far, the Npas issues revolved around the capital of the bank and how to fund them so that they start giving loans again. But more important issue is to find out a way to resolve the Npas created by the corporate houses, as why they are stressed. 2. It is an economic problem, not a morality play. Diversion of funds, willful defaults, have undoubtedly been one reason behind non-payment of the debts. But a large number of loan defaults have been caused by unexpected changes in the economic environment, timetables, exchange rates, and growth rate assumptions going wrong. 3. The stressed debt is heavily concentrated in large companies. This is an opportunity, because TBS could be overcome by solving a relatively small number of cases. But it presents an even bigger challenge, because large cases are inherently difficult to resolve. 4. Many of these companies are unviable at current levels of debt, requiring debt write-downs in many cases. Cash flows in the large, stressed companies have been deteriorating over the past few years, to the point where debt reductions of more than 50% will often be needed to restore viability. The only alternative would be to convert debt to equity, take over the companies, and then sell them at a loss. 5. Banks are finding it difficult to resolve these cases, despite a proliferation of schemes to help them. Among other issues, they face severe coordination problems, since large debtors have many creditors with different interests. If Psb'S grant large debt reductions, this could attract the attention of the investigative agencies. But taking over large companies will be politically difficult as well. 6. Delay is costly. Since banks can't resolve the big cases, they have simply refinanced the debtors, deteriorating the situation. But this is costly for the government because it means the bad debts keep rising, increasing the ultimate recapitalization bill for the government and the associated political difficulties. Delay is also costly for the economy because impaired banks are scaling back their credit, while stressed companies are cutting their investments. 7. Progress may require a para. The ARCs, asset reconstruction companies, haven't proved any more successful than banks in resolving bad debts. But international experience shows that a professionally run central agency with government backing, not without its own difficulties, can provide the solution in this regard. By late February 2017, government hinted towards its interest to the idea of para. But before the idea takes shape, several related issues are to be settled by the government, such as its funding mechanism, selection of the companies for their balance sheet resolution, recovery mechanism of the banks, Npas, etc., among others. Insolvency and bankruptcy. By now, several measures were put in place by the government or RBI to resolve the twin balance sheet (TBS) crisis faced by the economy, but they could not bring out effective results. Finally, we see the government moving to make the insolvency procedure effective to address the issue. The lenders, banks, and borrowers, private corporate sector, both have been paying a high financial cost of country's complex and time-taking process of insolvency and bankruptcy process. The new Insolvency and Bankruptcy Code, 2016, IBC, was amended and enforced by the government in November 2017. There has been a significant amount of progress in this regard. The entire mechanism for the corporate insolvency resolution process, SAR, has been put in place. A number of rules and regulations have been notified to create the institutions and professionals necessary for the process to work. A large number of cases have entered the insolvency process. A major factor behind the effectiveness of the new code has been the adjudication by the judiciary. It prescribes strict time limits for various procedures under it. In spite of the large inflow of cases to NCLT benches across India, these benches have been able to admit or reject applications for SAR admissions with few delays. In addition, appellate courts, including the NCLT, High Courts, and the Supreme Court have also disposed appeals quickly and decisively. In this process, a rich case law has evolved, reducing future legal uncertainty. In the SAR, the Committee of Creditors, COSI, invites resolution plans from resolution applicants and may select one of these plans. The code originally does not specify any restrictions on who these resolution applicants might be, though it declares some persons are ineligible to submit resolution plans. 1. An undischarged insolvent. 2. A willful defaulter. 3. A borrower whose account has been identified as a non-performing asset for over a year and who has not repaid the amount before submitting a plan. 4. A person convicted of an offence punishable with 2 or more years of imprisonment. 5. A person disqualified as a director under the Companies Act, 2013. 6. A person prohibited from trading in securities. 7. A person who is the promoter or in the management of a company which has indulged in undervalued, preferential, or fraudulent transactions. 8. A person who has given guarantee on a liability of the defaulting company undergoing resolution or liquidation and has not honored the guarantee 9. A person who is subject to any of the above disabilities in any jurisdiction outside India. Or 10. A person who has a connected person disqualified in any manner above. Amendments in the Code. The government has been proactively addressing the issues that come up in implementation of the IBC 2016. To ensure proper operationalization of it, till 2019 to 2020, the government has effected 3 important amendments in it. 1. The first amendment introduced Section 29, which deals with the provision introduced to bar promoters from bidding for their own companies. It prevented defaulters from regaining control of their companies at a cheaper value. 2. The Second Amendment introduced Section 12 AM to provide creditors option to withdraw insolvency application within 30 days of filing the petition. The amendment also stated that home buyers shall be treated as financial creditors. This move was aimed at mainly 2 issues. Firstly, giving home buyers a voice in the insolvency proceedings as they also provide funding for projects by making advance payments, and secondly, to discourage real estate developers from defaulting on commitments not only to banks but also to their customers. 3. The Third Amendment has been primarily focused upon the revival of a CD, corporate debtor, by ensuring timely admission and completion of the resolution process. The amendment ensures that 14 days period deadline given to the NCLT for admitting or rejecting a resolution application shall be strictly adhered to. The amendment further specifying the mandatory time frame of 330 days to complete the corporate insolvency resolution process, SIR, without exception, tries to instill discipline amongst the stakeholders to avoid inordinate delays in the insolvency resolution process. The government also reaffirms its stance as a facilitator in the Third Amendment by specifically making a resolution plan binding on the central government, state governments, or a local authority to whom debt in respect of payment of dues is owed. Performance of the Code. 3 years into operation, the regime under the IBC boasts of a strong ecosystem performing much better than the previous regimes. The debtors and creditors alike are initiating the processes under the Code. Up to September 2019, about 743 of them have completed the process yielding either resolution or liquidation, and 498 corporates have commenced voluntary liquidation process. Out of the 562 corporate insolvency resolution process, CIRPs, initiated in October to December 2019, 132 were under liquidation, and 14 were already settled. By the end of December 2019, 1.58 lakh rupees crore were realizable in cases resolved. By December 2019, the IBC ecosystem comprised the Adjudicating Authority, the Rbi, Insolvency and Bankruptcy Board of India, 3 insolvency professional agencies, 11 registered valuer organizations and 2,374 registered valuers and 2,911 insolvency professionals, IPs. The Rbi has conceptualized a 24-month professional course, the GIP, Graduate Insolvency Program. The resolution under IBC has been much higher as compared to other processes. The amount recovered as a percentage of amount involved in 2017 to 2018 and 2018 to 2019 has been much higher as compared to Lok Adalat, DRTs, etc. The Code provides a timeline of 330 days to conclude a SIR. This push has meant that proceedings under the Code take on average about 340 days, including time spent on litigation, in contrast with the previous regime, where processes took about 4.3 years. SURFACE Act, 2002. GOI finally cracked down on the willful defaulters by passing the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest (SARFAESI) Act, 2002. The Act gives far-reaching powers to the banks or FIs concerning NPAs. 1. Banks or FIs having 75% of the dues owed by the borrower can collectively proceed on the following in the event of the account becoming NPA. 1. Issue notice of default to borrowers asking to clear dues within 60 days. 2. On the borrower's failure to repay, A. Take possession of security and/or B. Take over the management of the borrowing concern and/or C. Appoint a person to manage the concern. 3. If the case is already before the BIFR, the proceedings can be stalled if banks or FIs having 75% share in the dues have taken any steps to recover the dues under the provisions of the ordinance. 2. The banks or FIs can also sell the security to a securitization or asset reconstruction company, ARC, established under the provisions of the ordinance. The ARC is sought to be set up on the lines similar to the USA few years ago. Willful defaulter. There are many people and entities who borrow money from lending institutions but fail to repay. However, not all of them are called willful defaulters. As is embedded in the name, a willful defaulter is one who does not repay a loan or liability, but apart from this there are other things that define a willful defaulter. According to the RBI, a willful defaulter is one who, 1. Is financially capable to repay, and yet does not do so, 2. Or one who diverts the funds for purposes other than what the fund was availed for, 3. Or with whom funds are not available in the form of assets as funds have been siphoned off, 4. Or who has sold or disposed the property that was used as a security to obtain the loan. Diversion of fund includes activities such as using short-term working capital for long-term purposes, acquiring assets for which the loan was not meant for, and transferring funds to other entities. Siphoning of funds means that funds were used for purposes that were not related to the borrower and which could affect the financial health of the entity. However, a lending institution cannot term an entity or an individual a willful defaulter for a one-off case of default and needs to take into account the repayment track record. The default should be established to be intentional, and the defaulter should be informed about the same. The defaulter should also be given a chance to clarify his stand on the issue. Also, the default amount needs to be at least 25 lakh rupees to be included in the category of willful defaults. If an entity's or individual's name figures in the list of willful defaulters, the following restrictions get in action on them. 1. Barred from participating in the capital market. 2. Barred from availing any further banking facilities and to access financial institutions for 5 years for the purpose of starting a new venture. 3. The lenders can initiate the process of recovery with full vigor and can even initiate criminal proceedings if required. 4. The lending institutions may not allow any person related to the defaulting company to become a board member of any other company as well. Capital adequacy ratio. At first sight, bank is a business or industry, a segment of the service sector in any economy. But the failure of a bank may have far greater damaging impact on an economy than any other kind of business or commercial activity. Basically, modern economies are heavily dependent on banks today than in the past. Banks are today called the backbone of economies. Healthy functioning of banks is today essential for the proper functioning of an economy. As credit creation, i.e., loan disbursals, of banks are highly risky business, the depositor's money depends on the bank's quality of lending. More importantly, the whole payment system, public as well as private, depends on banks. A bank's failure has the potential of creating chaos in an economy. This is why governments of the world pay special attention to the regulatory aspects of the banks. Every regulatory provision for banks tries to achieve a simple equation, i.e., how the banks should maximize their credit creation by minimizing the risk and continue functioning permanently. In the banking business, risks are always there and cannot be made zero, as any loan forwarded to any individual or firm, irrespective of their creditworthiness, has the risk of turning out to be a bad debt, i.e., NPA in India, the probability of this being 50%. But banks must function so that economies can function. Finally, the central banks of the world started devising tools to minimize the risks of banking at one hand and providing cushions, shock absorbers, to the banks at the other hand so that banks do not go bust, i.e., shut down after becoming bankrupt. Providing cushion or shock absorbers to banks has seen three major developments. 1. The provision of keeping a cash ratio of total deposits mobilized by the banks, known as the CRR in India. 2. The provision of maintaining some assets of the deposits mobilized by the banks with the banks themselves in non-cash form, known as the SLR in India. And 3. The provision of the capital adequacy ratio, CAR, non. The capital adequacy ratio, CAR, non has been the last provision to emerge in the area of regulating the banks in such a way that they can sustain the probable risks and uncertainties of lending. It was in 1988 that the central banking bodies of the developed economies agreed upon such a provision, the CAR, also known as the Basel Accord. The accord was agreed upon at Basel, Switzerland at a meeting of the Bank for International Settlements, BIS. It was at this time that the Basel Ii norms of the capital adequacy ratio were agreed upon. A requirement was imposed upon the banks to maintain a certain amount of free capital, i.e., ratio, to their assets, i.e., loans and investments by the banks, as a cushion against probable losses in investments and loans. In 1988, this ratio capital was decided to be 8%. It means that if the total investments and loans forwarded by a bank amounts to 100 rupees, the bank needs to maintain a free capital of 8 rupees at that particular time. The capital adequacy ratio is the percentage of total capital to the total risk-weighted assets. See footnote 46. CAR, a measure of a bank's capital, is expressed as a percentage of a bank's risk-weighted credit exposures. CAR is equal to total of the Tier 1 and Tier 2 capitals divided by risk-weighted assets. Also known as capital to risk-weighted assets ratio, CRAR, this ratio is used to protect depositors and promote the stability and efficiency of financial systems around the world. Two types of capital were measured as per the Basel II norms: Tier 1 capital, which can absorb losses without a bank being required to cease trading, and Tier 2 capital, which can absorb losses in the event of a winding up, and so provides a lesser degree of protection to depositors. The new norms, Basel III, has devised a third category of capital, i.e., Tier 3 capital. The RBI introduced the capital to risk-weighted assets ratio, CRAR, system for the banks operating in India in 1992 in accordance with the standards of the BIS, as part of the financial sector reforms. In the coming years, the Basel norms were extended to term lending institutions, primary dealers, and non-banking financial companies, NBFCs, too. Meanwhile, the BIS came up with another set of car norms, popularly known as Basel II. The RBI guidelines regarding the car norms in India have been as given below. Basel I norm of the car was to be achieved by the Indian banks by March 1997. The car norm was raised to 9% with effect from 31st March 2000. Narasimham Committee too had recommended to raise it to 10% in 1998. 3. Foreign banks as well as Indian banks with foreign presence to follow Basel II norms, WF 31st March 2008, while other scheduled commercial banks to follow it not later than 31st March 2009. The Basel II norm for the car is 12%. Why to maintain car? The basic question which comes to mind is as to why do the banks need to hold capital in the form of car loans? Two reasons have been generally forwarded for the same. One, bank capital helps to prevent bank failure, which arises in case the bank cannot satisfy its obligations to pay the depositors and other creditors. The low capital bank has a negative net worth after the loss in its business. In other words, it turns into insolvent capital, therefore, acts as a cushion to lessen the chance of the bank turning insolvent. 2. The amount of capital affects returns for the owners, equity holders of the bank. Basel Accords. The Basel Accords, i.e., Basel I, II and now III, are a set of agreements set by the Basel Committee on Bank Supervision, Psb'S, which provides recommendations on banking regulations in regards to capital risk, market risk, and operational risk. The purpose of the accords is to ensure that financial institutions have enough capital on account to meet obligations and absorb unexpected losses. They are of paramount importance to the banking world and are presently implemented by over 100 countries across the world. The BIS Accords were the outcome of a long drawn-out initiative to strive for greater international uniformity in prudential capital standards for banks' credit risk. The objectives of the Accords could be summed up as 1. To strengthen the international banking system, 2. To promote convergence of national capital standards, and 3. To iron out competitive inequalities among banks across countries of the world. The Basel Capital Adequacy Risk-Related Ratio Agreement of 1988, i.e., Basel I, was not a legal document. It was designed to apply to internationally active banks of member countries of the Basel Committee on Banking Supervision, Psb'S, of the BIS at Basel, Switzerland. But the details of its implementation were left to national discretion. This is why Basel I looked G10-centric. The first Basel Accord, known as Basel I, focuses on the capital adequacy of financial institutions. The capital adequacy risk, the risk a financial institution faces due to an unexpected loss, categorizes the assets of financial institution into 5 risk categories: 0%, 10%, 20%, 50%, 100%. Banks that operate internationally are required to have a risk weight of 8% or less. The second Basel Accord, known as Basel II, is to be fully implemented by 2015. It focuses on 3 main areas, including minimum capital requirements, supervisory review, and market discipline, which are known as the 3 pillars. The focus of this accord is to strengthen international banking requirements as well as to supervise and enforce these requirements. The third Basel Accord, known as Basel III, is a comprehensive set of reform measures aimed to strengthen the regulation, supervision, and risk management of the banking sector. These measures aim to 1. Improve the banking sector's ability to absorb shocks arising from financial and economic stress, whatever the source be, 2. Improve risk management and governance, and 3. Strengthen banks' transparency and disclosures. The capital of the banks has been classified into 3 tiers as given below. Tier 1 capital, a term used to describe the capital adequacy of a bank. It can absorb losses without a bank being required to cease trading. This is the core measure of a bank's financial strength from a regulator's point of view. This is the most reliable form of capital. It consists of the types of financial capital considered the most reliable and liquid, primarily stockholders' equity and disclosed reserves of the bank. Equity capital can't be redeemed at the option of the holder, and disclosed reserves are the liquid assets available with the bank itself. Tier 2 capital, a term used to describe the capital adequacy of a bank. It can absorb losses in the event of a winding up, and so provides a lesser degree of protection to depositors. Tier 2 capital is secondary bank capital, the second most reliable forms of capital. This is related to Tier 1 capital. This capital is a measure of a bank's financial strength from a regulator's point of view. It consists of accumulated after-tax surplus of retained earnings, revaluation reserves of fixed assets, and long-term holdings of equity securities, general loan loss reserves, hybrid, debt or equity, capital instruments, and subordinated debt and undisclosed reserves. Tier 3 capital, a term used to describe the capital adequacy of a bank, considered the tertiary capital of the banks, which are used to meet or support market risk, commodities risk, and foreign currency risk. It includes a variety of debt other than Tier 1 and Tier 2 capitals. Tier 3 capital debts may include a greater number of subordinated issues, undisclosed reserves, and general loss reserves compared to Tier 2 capital. To qualify as Tier 3 capital, assets must be limited to 250% of a bank's Tier 1 capital, be unsecured, subordinated, and have a minimum maturity of 2 years. Disclosed reserves are the total liquid cash and the SLR assets of the banks that may be used any time. This way they are part of its core capital, Tier 1. Undisclosed reserves are the unpublished or hidden reserves of a financial institution that may not appear on publicly available documents such as a balance sheet, but are nonetheless real assets, which are accepted as such by most banking institutions, but cannot be used at will by the bank. That is why they are part of its secondary capital, Tier 2. Basel III provisions. The Basel III provisions have defined the capital of the banks in different way. They consider common equity and retained earnings as the predominant component of capital, as the past, but they restrict inclusion of items such as deferred tax assets, mortgage servicing rights, and investments in financial institutions to no more than 15% of the common equity component. These rules aim to improve the quantity and quality of the capital. While the key capital ratio has been raised to 7% of risky assets, according to the new norms, Tier I capital, that includes common equity and perpetual preferred stock, will be raised from 2 to 4.5% starting in phases from January 2013 to be completed by January 2015. In addition, banks will have to set aside another 2.5% as a contingency for future stress. Banks that fail to meet the buffer would be unable to pay dividends, though they will not be forced to raise cash. The new norms are based on renewed focus of central bankers on macroprudential stability. The global financial crisis following the crisis in the US subprime market has prompted this change in approach. The previous set of guidelines popularly known as Basel II, focused on macroprudential regulation. In other words, global regulators are now focusing on financial stability of the system as a whole, rather than micro-regulation of any individual bank. Banks in the West, which are market leaders for the most part, face low growth and erosion in capital due to sovereign debt exposures and stiffer regulation. They will have to reckon with a permanent decline in their returns on equity thanks to enhanced capital requirements under the new norms. In contrast, Indian banks, and those in other emerging markets such as China and Brazil, are well placed to maintain their returns on capital consequent to Basel III. Financial experts have opined that Basel III looks changing the economic landscape in which banking power shifts towards the emerging markets. Basel III compliance of the Psb'S and RRBs. The capital to risk-weighted assets ratio, CRAR, of the scheduled commercial banks of India was 13.02% by March 2014, Basel III, falling to 12.75% by September 2014. The regulatory requirement for CRAR is 9% for 2015. The decline in capital positions at aggregate level, however, was on account of deterioration in capital positions of Psb'S. While the CRAR of the scheduled commercial banks, SCB, at 12.75% as of September 2014 was satisfactory, going forward the banking sector, particularly Psb'S, will require substantial capital to meet regulatory requirements with respect to additional capital buffers. In order to make the Psb'S and RRBs compliant to the Basel III norms, the government has been following a recapitalization program for them since 2011-12. A high-level committee on the issue was also set up by the government, which has suggested the idea of non-operating holding company, holdco, under a special act of parliament. Action is yet to come regarding this. Meanwhile, the government has infused 3 tranches of capital into the banks. Infused funds go to the RRBs, 2 through the Psb'S under whom they fall. Up to March 2015, 1. 12,000 crore rupees infused during 2012-13 in 7 Psb'S. 2. 12,517 crore rupees infused in 2013-14 in 8 Psb'S. 3. In 2014-15. The Psb'S were recapitalized with 6,990 crore rupees. This capital infusion was based on some new criteria: asset quality, efficiency, and strength of the banks. 4. During 2015-16, the government released 19,950 crore rupees to 13 Psb'S, Economic Survey 2015-16. 5. For the year 2016-17, the government has announced a sum of 25,000 crore rupees for the purpose of recapitalizing the Psb'S, Union Budget 2016-17. 6. The Indradhanush scheme was launched in 2015-16 by the government, under which the Psb'S are to be infused with 70,000 crore rupees by March 2019 to enable them meet the global risk norms, i.e., Basel III norms. 7. The ongoing recapitalization process of the Psb'S got a big boost when the government announced, February 2018, a hefty sum of 2.11 lakh rupees crores for it. Infused into the Psb'S up to October 2019, a part of it, 1.35 lakh rupees crores, will be mobilized through recapitalization bonds, while rest of it, 76,000 crores rupees, will be raised by the banks from market, disinvestment process, and budgetary support. This process will help the banks in meeting their capital adequacy targets also. As per the latest Economic Survey 2019-20, by September, the capital to risk-weighted asset ratio (CRAR) of the scheduled commercial banks (SCBs) was 12.8%. It was 13.9% by March 2018, largely due to an improvement among the PVBs, private sector banks. Stock of money. In every economy, it is necessary for the central bank to know the stock, amount or level of money available in the economy. Only then it can go for suitable kind of credit and monetary policy. Saying simply, credit and monetary policy of an economy is all about changing the level of the money flowing in the economic system. But it can be done only when we know the real flow of money. That's why it is necessary to first assess the level of money flowing in the economy. Following the recommendations of the Second Working Group on Money Supply, SWG, in 1977, RBI has been publishing 4 monetary aggregates, component of money, viz. M1, M2, M3, and M4, are basically short terms for Money 1, Money 2, Money 3, and Money 4, besides the reserve money. These components used to contain money of differing liquidities. M1 is equal to currency and coins with people plus demand deposits of banks, current and saving accounts, plus other deposits of the RBI. M2 is equal to M1 plus demand deposits of the post offices, i.e., saving schemes money. M3 is equal to M1 plus time or term deposits of the banks, i.e., the money lying in the recurring deposits and the fixed deposits. M4 is equal to M3 plus total deposits of the post offices, both demand and term or time deposits. Now the RBI has started publishing a set of new monetary aggregates following the recommendations of the Working Group on Money Supply, Analytics, and Methodology of Compilation, Chairman, Dr. Y. V. Reddy, which submitted its report in June 1998. The Working Group recommended compilation of 4 monetary aggregates on the basis of the balance sheet of the banking sector in conformity with the norms of progressive liquidity, M0, monetary base, M1, narrow money, M2 and M3, broad money. In addition to the monetary aggregates, the Working Group had recommended compilation of 3 liquidity aggregates, namely L1, L2 and L3, which include select items of financial liabilities of non-depository financial corporations such as development financial institutions and non-banking financial companies accepting deposits from the public, apart from post office savings banks. The new monetary aggregates are as given below. Reserve money, M0, is equal to currency in circulation plus bankers' deposits with the RBI plus other deposits with the RBI. Narrow money, M1, is equal to currency with the public plus demand deposits with the banking system plus other deposits with the RBI. M2 is equal to M1 plus savings deposits of post office savings banks. Broad money, M3, is equal to M1 plus time deposits with the banking system. M4 is equal to M3 plus all deposits with post office savings banks, excluding national savings certificates. While the Working Group did not recommend any change in the definition of reserve money, and M1, it proposed a new intermediate monetary aggregate to be referred to as NM, to comprising currency and residence short-term bank deposits with contractual maturity up to and including 1 year, which would stand in between narrow money, which includes only the non-interest-bearing monetary liabilities of the banking sector, and broad money, an all-encompassing measure that includes long-term time deposits. The new broad money aggregate referred to as NM3 for the purpose of clarity, in the monetary survey would comprise, in addition to NM2, long-term deposits of residents as well as call or term borrowings from non-bank sources, which have emerged as an important source of resource mobilization for banks. The critical difference between M3 and NM3 is the treatment of non-resident repatriable fixed foreign currency liabilities of the banking system in the money supply compilation. There are two basic changes in the new monetary aggregates. First, since the Post Office Bank is not a part of the banking sector, postal deposits are no longer treated as part of money supply, as was the case in the extant M2 and M4. Second, the residency criterion was adopted to a limited extent for compilation of monetary aggregates. The working group made a recommendation in favor of compilation of monetary aggregates on residency basis. Residency essentially relates to the country in which the holder has a center of economic interest. Holdings of currency and deposits by the non-residents in the rest of the world sector would be determined by their portfolio choice. However, these transactions form part of balance of payments, BOP. Such holdings of currency and deposits are not strictly related to the domestic demand for monetary assets. It is therefore argued that these transactions should be regarded as external liabilities to be netted from foreign currency assets of the banking system. However, in the context of developing countries such as India, which have a large number of expatriate workers who remit their savings in the form of deposits, it could be argued that these non-residents have a center of economic interest in their country of origin. Although in a macroeconomic accounting framework, all non-resident deposits need to be separated from domestic deposits and treated as capital flows, the underlying economic reality may point otherwise. In the Indian context, it may not be appropriate to exclude all categories of non-resident deposits from domestic monetary aggregates, as non-resident rupee deposits are essentially integrated into the domestic financial system. The new monetary aggregates, therefore, exclude only non-resident repatriable foreign currency fixed deposits from deposit liabilities and treat those as external liabilities. Accordingly, from among the various categories of non-resident deposits at present, only foreign currency non-resident accounts, banks, FCNR, B, deposits are classified as external liabilities and excluded from the domestic money stock. Since the bulk of the FCNR, B, deposits are held abroad by commercial banks, the monetary impact of changes in such deposits is captured through changes in net foreign exchange assets of the commercial banks. Thus, now the new monetary aggregates NM2 and NM3 as well as liquidity aggregates L1, L2 and L3 have been introduced, the components of which are elaborated as follows. NM1 is equal to currency with the public plus demand deposits, with the banking system plus other deposits, with the RBI. NM2 is equal to NM1 plus short-term time deposits of residents, including the contractual maturity of 1 year. NM3 is equal to NM2 plus long-term time deposits of residents plus call or term funding from financial institutions. L1 is equal to NM3 plus all deposits with the post office savings banks, excluding national savings certificates. L2 is equal to L1 plus term deposits with term lending institutions and refinancing institutions, FIs, plus term borrowing by FIs plus certificates of deposit issued by FIs. L3 is equal to L2 plus public deposits of non-banking financial companies. Data on M0 are published by the RBI on weekly basis, while those for M1 and M3 are available on fortnightly basis. Among liquidity aggregates, data on L1 and L2 are published monthly, while those for L3 are disseminated quarterly. The working group advised for the quarterly publication of Financial Sector Survey to capture the dynamic linkages between banks and rest of the organized financial sector. Liquidity of money. As we move from M1 to M4, the liquidity, inertia, stability, spendability of the money goes on decreasing, and in the opposite direction, the liquidity increases. Narrow money. In banking terminology, M1 is called narrow money as it is highly liquid and banks cannot run their lending programs with this money. Broad money. The money component M3 is called broad money in the banking terminology. With this money, which lies with banks for a known period, banks run their lending programs. Money supply. In general discussion, we usually use money supply to mean money circulation, money flow in the economy. But in banking and typical monetary management terminology, the level and supply of M3 is known as money supply. The growth rate of broad money, M3, i.e., money supply, was not only lower than the indicative growth set by the Reserve Bank of India, but it also witnessed continuous and sequential deceleration in the last 7 quarters and moderated to 11.2% by December 2012. Aggregate deposits with the banks were the major component of broad money, accounting for over 85%, remaining almost stable. The sources of broad money are net bank credit to the government and to the commercial sector. These two together accounted for nearly 100% of the broad money in 2012-13, compared to 89% in 2009-10. High power money. The central banks of all the countries are empowered to issue the currency. The currency issued by the central bank is called high power money because it is generally backed by supporting reserves and its value is guaranteed by the government, and it is the source of all other forms of money. The currency issued by the central bank is, in fact, a liability of the central bank and the government. In general, therefore, this liability must be backed by an equal value of assets consisting mainly gold and foreign exchange reserves. In practice, however, most countries have adopted a minimum reserve system. Under the minimum reserve system, the central bank is required to keep a certain minimum reserve of gold and foreign securities and is empowered to issue currency to any extent. India adopted this system in October 1956. The RBI was required to hold a reserve worth of only 515 crore rupees consisting of foreign securities worth 400 crore rupees and gold worth 115 crore rupees. In 1957, however, the minimum reserves were further reduced to only gold reserve of 115 crore rupees and the rest in the form of rupee securities, mainly due to the scarcity of foreign exchange to meet essential import bill. A gold reserve of 115 crore rupees against the currency of 17 lakhs crore rupees in circulation today makes only 0.7% reserve, which is of no consequence. This makes the Indian currency system a managed paper currency system. In India, there are two sources of high power money supply, one RBI and two Government of India. The RBI issues currency notes of rupees 2, 5, 10, 20, 50, 100, 500 and 2000 denominations, which RBI calls as the reserve money. The RBI issues currency of 1 rupee notes and coins including coins of smaller denominations on behalf of the Government of India, which accounts for around 2% of the total high-power money. Minimum reserve. The RBI is required to maintain a reserve equivalent of 200 crores rupees in gold and foreign currency with itself, of which 115 crores rupees should be in gold. Against this reserve, the RBI is empowered to issue currency to any extent. This is being followed since 1957 and is known as the Minimum Reserve System, MRS. Reserve money. The gross amount of the following 6 segments of money at any point of time is known as reserve money. RM. For the economy or the government. 1. RBI's net credit to the government. 2. RBI's net credit to the banks. 3. RBI's net credit to the commercial banks. 4. Net forex reserve with the RBI. 5. Government's currency liabilities to the public. 6. Net non-monetary liabilities of the RBI. RM is equal to 1 plus 2 plus 3 plus 4 plus 5 plus 6. Money multiplier. At end March 2014, the money multiplier ratio of M3 to M0 was 5.2, higher than end March 2015, due to cumulative 125 basis point reduction in CRR. During 2015 to 16, the money multiplier generally stayed high, reflecting again the CRR cuts. As on 31st December 2018, the money multiplier was 6.0 compared with 5.5 on the corresponding date of the previous year, as per the RBI. Credit counseling. Advising borrowers to overcome their debt burden and improve money management skills is credit counseling. The first such well-known agency was created in the USA when credit grantors created National Foundation for Credit Counseling, NFCC, in 1951. India's sovereign debt is usually rated by 6 major sovereign credit rating agencies, SCRAs, of the world, which are 1. Fitch Ratings, 2. Moody's Investors Service, 3. Standard & Poor's, S&P, 4. Dominion Bond Rating Service, DBRS, 5. Japanese Credit Rating Agency, JCRA, and 6. Rating and Investment Information Incorporated, Tokyo, R&I. As on 15th January 2013, most of these rating agencies have put India under stable category in foreign and local currencies, barring Fitch and S&P, which have put its foreign currency in negative category. The government is taking a number of steps to improve its interaction with the major SCRAs so that they make informed decisions, as the Economic Survey 2012-13 says. Credit rating. To assess the creditworthiness, credit record, integrity, capability of a prospective would-be borrower to meet debt obligations is credit rating. Today it is done in the cases of individuals, companies, and even countries. There are some world-renowned agencies such as the Moody's, S&P. The concept was first introduced by John Moody in the USA, 1909. Usually equity share is not rated here. Primarily, ratings are an investor service. Credit rating was introduced in India is 1988 by the ICICI and UTI jointly. The major credit rating agencies of India are 1. CRISIL, Credit Rating Information of India Limited, was jointly promoted by ICICI and UTI with share capital coming from SBI, LIC, United India Insurance Company Limited to rate debt instrument, debenture. In April 2005, its 51% equity was acquired by the US credit rating agency S&P, a McGraw-Hill group of companies. 2. ICRA, Investment Information and Credit Rating Agency of India Limited, was set up in 1991 by IFCI, LIC, SBI and select banks as well as financial institutions to rate debt instruments. 3. CARE, Credit Analysis and Research Limited, was set up in 1993 by IDBI, other financial institutions, nationalized banks and private sector finance companies to rate all types of debt instruments. 4. ONICRA, Onida Individual Credit Rating Agency of India Limited, was set up by Onida Finance, a private sector finance company, in 1995 to rate creditworthiness of non-corporate consumers and their debt instruments, i.e., credit cards, hire purchase, housing finance, rental agreements and bank finance. 5. SMERA, Small and Medium Enterprises Rating Agency, was set up in September 2005 to rate the overall strength of small and medium enterprises, SMEs, the erstwhile SSIs. It is not a credit rating agency precisely, but its ratings are used for this purpose, too. A joint venture of Citb, the largest shareholder with 22% stake, SBI, ICICI Bank, Dun & Bradstreet, an international credit information company, 5 public sector banks, PNB, BOB, BOI, Canara Bank, UBI with 28% stake together, and CIBIL, Credit Information Bureau of India Limited. A general credit rating service not linked to any debt issue is also availed by companies already offered in India by rating agencies. CRISIL calls such ratings as credit assessment. International rating agencies such as Moody's, S&P also undertake sovereign ratings, i.e. of countries, highly instrumental in external borrowings of the countries. Individuals are also covered by credit appraisal, which is on useful information for the consumer credit funds. To maintain a database on the credit records of individuals, the Credit Information Bureau of India Limited, CIBIL, was set up in May 2004, which makes credit informations available to banks and financial institutions about prospective individual borrowers. Non-resident Indian deposits. Foreign Exchange Management, Deposit, Regulations, 2000 permits non-resident Indians, NRIs, to have deposit accounts with authorized dealers and with banks authorized by the Reserve Bank of India, RBI, which include 1. Foreign Currency Non-Resident, Bank, Account, FCNR, B, Account, 2. Non-Resident External Account, NRE Account, 3. Non-Resident Ordinary Rupee Account, NRO Account. FCNR, B, accounts can be opened by NRIs and overseas corporate bodies, OCBs, with an authorized dealer. The accounts can be opened in the form of term deposits. Deposits of funds are allowed in pound sterling, US dollar, Japanese yen, and euro. Rate of interest applicable to these accounts are in accordance with the directives issued by RBI from time to time. NRE accounts can be opened by NRIs and OCBs with authorized dealers and with banks authorized by RBI. These can be in the form of savings, current, recurring or fixed deposit accounts. Deposits are allowed in any permitted currency. Rate of interest applicable to these accounts are in accordance with the directives issued by RBI from time to time. NRO accounts can be opened by any person resident outside India, with an authorized dealer or an authorized bank for collecting their funds from local bona fide transactions in Indian rupees. When a resident becomes an NRI, his existing rupee accounts are designated as NRO. These accounts can be in the form of current, savings, recurring or fixed deposit accounts. There were 2 more NRI deposit accounts in operation, viz. non-resident, non-repatriable, rupee deposit account, and non-resident, special, rupee account, and amendment to Foreign Exchange Management, deposit, regulations, in 2002, discontinued the acceptance of deposits in these two accounts from April 2002 onwards. Repatriation of funds in FCNR, B, and NRE accounts is permitted. Hence, deposits in these accounts are included in India's external debt outstanding. While the principal of NRO deposits is non-repatriable, current income and interest earning is repatriable. Account holders of NRO accounts are permitted to annually remit an amount up to $1 million out of the balances held in their accounts. Therefore, deposits in NRO accounts too are included in India's external debt. Nidhi. Nidhi in the Indian context means treasure. However, in the Indian financial sector it refers to any mutual benefit society notified by the central or union government as a Nidhi company. They are created mainly for cultivating the habit of thrift and savings amongst its members. The companies doing Nidhi business, viz., borrowing from members and lending to members only, are known under different names such as Nidhi, Permanent Fund, Benefit Funds, Mutual Benefit Funds and Mutual Benefit Company. Nidhis are more popular in South India and are highly localized single-office institutions. They are mutual benefit societies because their dealings are restricted only to the members and membership is limited to individuals. The principal source of funds is the contribution from the members. The loans are given to the members at relatively reasonable rates for purposes such as house construction or repairs and are generally secured. The deposits mobilized by Nidhis are not much when compared to the organized banking sector. Nidhis are companies registered under the Companies Act, 1956 and are regulated by the Ministry of Corporate Affairs, MCA. Even though Nidhis are regulated by the provisions of the Companies Act, 1956, they are exempted from certain provisions of the Act, as applicable to other companies, due to limiting their operations within members. Nidhis are also included in the definition of Nbfcs, which operate mainly in the unorganized money market. However, since 1997, Nbfcs have been brought increasingly under the regulatory ambit of the RBI. Non-banking financial entities partially or wholly regulated by the RBI include 1. Nbfcs comprising equipment leasing, L. Hire purchase finance, HP, loan, LC, investment, IC, including primary dealers, PDS, and residuary non-banking companies, RMBCs, 2. Mutual Benefit Financial Company, MBFC, I. Nidhi Company, 3. Mutual Benefit Company, MBC, i.e. Potential Nidhi Company, i.e. a company which is working on the lines of a Nidhi company, but has not yet been so declared by the central government, has minimum net own fund, NOF, of 10 lakh rupees, has applied to the RBI for certificate of registration and also to the Department of Company Affairs, DCA, for being notified as a Nidhi company, and has not contravened directions or regulations of RBI or DCA. 4. Miscellaneous Non-Banking Company, MNBC, i.e. Chit Fund Company. Since Nidhis come under one class of NBFCs, RBI is empowered to issue directions to them in matters relating to their deposit acceptance activities. However, in recognition of the fact that these Nidhis deal with their shareholder members only, RBI has exempted the notified Nidhis from the core provisions of the RBI Act and other directions applicable to NBFCs. As on date, February 2013, RBI does not have any specified regulatory framework for nidhis. The central government in March 2000 constituted a committee to examine the various aspects of the functioning of nidhi companies. There was no government notification defining the word nidhi. Taking into consideration the manner of functioning of nidhis and the recommendations of the Psb'S Committee in its report, and also to prevent unscrupulous persons using the word nidhi in their name without being incorporated by the Department of Company Affairs, DCA, and yet doing nidhi business, the committee suggested the following definition for nidhis. A part of this definition is appearing in the New Companies Bill 2012, Section 406. Nidhi is a company formed with the exclusive object of cultivating the habit of thrift, savings and functioning for the mutual benefit of members by receiving deposits only from individuals enrolled as members and by lending only to individuals, also enrolled as members, and which functions as per notification and guidelines prescribed by the DCA. The word nidhi shall not form part of the name of any company, firm or individual engaged in borrowing and lending money without incorporation by DCA, and such contravention will attract penal action. Chit Fund. Recently, Chit Fund was in center of news after the Kolkata-based Sarda Chit Fund scam came to light. Most of the media people were themselves not very clear about the finer points related to the idea of chits in India, but they kept on highlighting chits as they needed to report on the scam. Let us try to understand what chits are and some other similar concepts in India. Chit funds, also known by their other names, such as Chitti, Kuri, miscellaneous non-banking company, are essentially saving institutions. They are of various forms and lack any standardized form. Chit funds have regular members who make periodical subscriptions to the fund. The periodic collection is given to some member of the chit funds selected on the basis of previously agreed criterion. The beneficiary is selected usually on the basis of bids or by draw of lots or in some cases by auction or by tender. In any case, each member of the chit fund is assured of his turn before the second round starts, and any member becomes entitled to get periodic collection again. Chit funds are the Indian versions of rotating savings and credit associations found across the globe. Chit fund business is regulated under the Central Chit Funds Act, 1982 and the rules framed under this act by the various state governments for this purpose. The central government has not framed any rules of operation for them. Thus, registration and regulation of chit funds are carried out by state governments under the rules framed by them. Functionally, chit funds are included in the definition of Nbfcs by the RBI under the subhead Miscellaneous Non-Banking Company, MNBC. But RBI has not laid out any separate regulatory framework for them. Official definition, as per the Chit Funds Act, 1982, chit means a transaction whether called chit, chit fund, chitti, kuri or by any other name by or under which a person enters into an agreement with a specified number of persons, that every one of them shall subscribe a certain sum of money, or a certain quantity of grain instead, by way of periodical installments over a definite period, and that each such subscriber shall, in his turn, as determined by lot or by auction or by tender or in such other manner as may be specified in the chit agreement, be entitled to the prize amount. A transaction is not a chit if in such transaction, one, some alone, but not all, of the subscribers get the prize amount without any liability to pay future subscriptions, or, two, all the subscribers get the chit amount by turns with a liability to pay future subscriptions. Small and payment banks. By mid-July 2014, the RBI issued the draft guidelines for setting up small banks and payment banks. The guidelines said that both are niche or differentiated banks with the common objective of furthering financial inclusion. It is in pursuance of the announcement made in the Union Budget 2014-15. The details regarding the provisions to set up such banks and their operational criteria are as given below. The guidelines to set up both the banks are same. The minimum capital requirement would be 100 crore rupees. Promoter contribution would be at least 40% for the first 5 years. Excess shareholding should be brought down to 40% by the end of 5th year, to 30% by the end of 10th year, and to 26% in 12 years from the date of commencement of business. Foreign shareholding in these banks will be as per current FDI policy. Voting rights to be line with the existing guideline for private banks. Entities other than promoters will not be permitted to have shareholding in excess of 10%. The bank should comply with the corporate governance guidelines, including fit and proper criteria for directors as issued by RBI. Operations of the bank should be fully networked and technology-driven from the beginning. Small banks. The purpose of the small banks will be to provide a whole suite of basic banking products, such as deposits and supply of credit, but in a limited area of operation. The objective of the small banks to increase financial inclusion by provision of savings vehicles to underserved and unserved sections of the population, supply of credit to small farmers, micro and small industries, and other unorganized sector entities through high technology low-cost operations. Other features of the small banks are as follows. 1. Resident individuals with 10 years of experience in banking and finance, companies and societies will be eligible as promoters to set up small banks. NFPCs, microfinance institutions, MFIs, and local area banks, labs, can convert their operations into those of a small bank. Local focus and ability to serve smaller customers will be a key criterion in licensing such banks. 2. For the initial 3 years, prior approval will be required for branch expansion. 3. The area of operations would normally be restricted to contiguous districts in a homogeneous cluster of states or union territories so that the small bank has a local feel and culture. However, if necessary, it would be allowed to expand its area of operations beyond contiguous districts in one or more states with reasonable geographical proximity. 4. The bank shall primarily undertake basic banking activities of accepting deposits and lending to small farmers, small businesses, micro and small industries, and unorganized sector entities. It cannot set up subsidiaries to undertake non-banking financial services activities. After the initial stabilization period of 5 years, and after a review, the RBI may liberalize the scope of activities for small banks. 5. The promoter's other financial and non-financial services activities, if any, should be distinctly ring-fenced and not commingled with banking business. 6. A robust risk management framework is required, and the banks would be subject to all prudential norms and RBI regulations that apply to existing commercial banks, including maintenance of CRR and SLR. 7. In view of concentration of area of operations, the small bank would need a diversified portfolio of loans spread over its area of operations. 8. The maximum loan size and investment limit exposure to single or group borrowers or issuers would be restricted to 15% of capital funds. 9. Loans and advances of up to 25 lakhs rupees, primarily to micro enterprises, should constitute at least 50% of the loan portfolio. 10. For the first 3 years, 25% of branches should be in unbanked rural areas. By April 2020, a total of 10 small banks were operating in the country. Payments banks. The objective of payments banks is to increase financial inclusion by providing small savings accounts, payment or remittance services to migrant labor, low-income households, small businesses, other unorganized sector entities, and other users by enabling high-volume low-value transactions in deposits and payments or remittance services in a secure technology-driven environment. Those who can promote a payments banks can be a non-bank PPIs, Nbfcs, corporates, mobile telephone companies, supermarket chains, real sector cooperatives companies and public sector entities. Even banks can take equity in payments banks. Payments banks can accept demand deposits, only current account and savings accounts. They would initially be restricted to holding a maximum balance of 100,000 rupees per customer. Based on performance, the RBI could enhance this limit. The banks can offer payments and remittance services, issuance of prepaid payment instruments, internet banking, functioning as business correspondent for other banks. Payments banks cannot set up subsidiaries to undertake NBFC business. As in the case of small banks, other financial and non-financial services activities of the promoters should be ring-fenced. The payments banks would be required to use the word payments in its name to differentiate it from other banks. No credit lending is allowed for payments banks. The float funds can be parked only in less than 1 year G6. By April 2020, a total of 6 payment banks were operating in the country. Financial inclusion. Financial inclusion is an important priority of the government. The objective is to ensure the excluded sections, i.e., weaker sections and low-income groups, access to various financial services such as a basic savings bank account, need-based credit, remittance facility, insurance and pension. The government has recently launched an effective scheme to promote the cause of financial inclusion, the PMJDY. Pradhan Mantri Jan Dhan Yojana. To achieve the objective of financial inclusion by extending financial services to the large hitherto unserved population of the country, and to unlock its growth potential, the Pradhan Mantri Jan Dhan Yojana, PMJDY, was launched on 28 August 2014. The Yojana envisages 1. Universal access to banking facilities with at least one basic banking account for every household. 2. Financial literacy, access to credit and insurance. 3. The beneficiaries will receive a Rbi debit card having inbuilt accident insurance cover of 1 lakh rupees. 4. In addition, there is a life insurance cover of 30,000 rupees to those who open their bank accounts for the first time between 15th August 2014 and 26th January 2015 and meet other eligibility conditions of the Yojana. The Yojana had entered the Guinness World Records for opening most bank accounts during the week starting 23rd August 2014 as part of the financial campaign. Gold investment schemes. 2 new gold investment schemes were launched by the Government of India by November 2015, the Sovereign Gold Bonds and Gold Monetization Schemes. The schemes are aimed at twin objectives: 1. Reducing the demand for physical gold, and 2. Shifting a part of the gold imported every year for investment purposes into financial savings. Brief feature of the schemes are as given below. Sovereign gold bonds. These are issued by RBI on behalf of the GOI in rupees and denominated in grams of gold and restricted for sale to the resident Indian entities only, both in demat and paper form. The minimum and maximum investment limits are 2 grams and 500 grams of gold per person per fiscal year, respectively. The rate of interest for the year 2015 to 16 was 2.75% per annum, payable on a half-yearly basis. The tenor of the bond is for a period of 8 years with exit option from 5th year onwards. KYC norms are the same as that for gold. Exemption from capital gains tax is also available. Redemption is made in the rupee value equivalent to the price of gold at the time of maturity. Gold Monetization Scheme. In this scheme, BIS, Bureau of Indian Standards, certified CPTCs, collection, purity testing centers, collect the gold from the customer on behalf of the banks. The minimum quantity of gold, bullion or jewelry, which can be deposited is 30 grams and there is no limit for maximum deposit. Gold saving account can be opened with any of the designated bank and denomination in grams of gold for short-term period of 1 to 3 years, a medium-term period of 5 to 7 years, and a long-term period of 12 to 15 years. The CPTCs transfer the gold to the refiners. The banks will have a tripartite or bipartite legal agreement with refiners and CPTCs. For the year 2020 to 21, interest rate is fixed at 2.25% and 2.5% for the medium and long term, respectively. Redemption is made in cash or gold for short term and in cash for medium and long term deposits. The difference between the current borrowing cost for the government and the interest rate paid by the government under the medium or long term deposit will be credited to the Gold Reserve Fund. In 2019 to 2020, the RBI liberalized the gold monetization scheme, allowing charitable institutions, the centre, states, and government entities to deposit the precious metal. Individuals, corporate entities, mutual funds, and exchange-traded funds were already allowed to deposit gold under the scheme. The aim of the scheme was to mobilize idle gold lying with households and temples into the system, and consequently, reduce imports. This move will help government agencies to deposit gold confiscated by them. Charitable institutions can now take advantage to deposit their unaccounted gold without disclosing their identity. In the past, several complaints were received by the government about money laundering by charitable trusts. They used to accept money eligible for donation tax benefit and give cash back to the donor. To prevent money laundering, a 30% tax has been imposed on charitable trusts for donations received from unidentified persons. It means now donors will deposit unaccounted gold and get cash after a deduction of 30% from these trusts. But this also allows the unaccounted gold to find its way into the scheme. Some experts believe that money collected by depositors like this could also be used to fund election campaigns. Under the scheme, a depositor has to give gold to a collection center, which are also hallmarking centers. These centers issue certificates of purity after melting the gold, which is sent to refineries for converting into bars. Banks issue deposit receipts after collecting purity certificates from depositors. Mudra Bank. As per the Government of India, large industries provide employment to only 1.25 crore people in the country, while the micro units employ around 12 crore people. There is a need to focus on these 5.75 crore self-employed people, owners of the micro units, who use funds of 11 lakh rupees crore, with an average per unit debt of nearly 17,000 rupees. Capital is the key to the small entrepreneurs. These entrepreneurs depend heavily on the local money lenders for their fund requirements. Looking at the importance of these enterprises, the Government of India launched, April 2015, the Micro Units Development and Refinance Agency Bank, Mudra Bank, with the aim of funding these unfunded non-corporate enterprises. This was launched as the PMMY, Prime Minister Mudra Yojana. Important features of the Mudra Bank are as given below. Under this banking model, the micro units can avail up to 10 lakh rupees loan through refinance route, through the public and private sector banks, Nbfcs, MFIs, RRBs, district banks, etc. The products designed under it are categorized into 3 buckets of finance named Shishu, loan up to 50,000 rupees, Kishore, 50,000 rupees to 5 lakh rupees, and Tarun, 5 lakh rupees to 10 lakh rupees. Though the scheme covers the traders of fruits and vegetables, in general, it does not refinance the agriculture sector. There is no fixed interest rate in this scheme. As per the Government of India, presently, banks are charging the interest rates between base rate plus 1% to 7% per annum. Interest rates on the loans are supposed to vary according to the risk involved in the enterprises seeking loans. There is no general subsidy offered on interest rates except if the loan is linked to some other government scheme. As per the government, by March 2020, a total of 22.53 crore loans were sanctioned since launch of the scheme. Total loans disbursed being to the tune of around 11.51 lakh rupees crores. Around 70% of the loan beneficiaries are women under the scheme. Meanwhile, the rise in the non-performing assets in case of the Mudra loans have been a matter of concern for the government and the RBI alike. As per the Ministry of Finance, between April to December 2019, the net Npas under the Mudra loans increased to 2.88% against 2.52% of the same period in 2018. Indian Economy by Ramesh Singh. Chapter 13. Insurance in India. Insurance is a kind of gambling in rivers, a major form of risk spreading. One person's risk, which would be large, is spread around to make it small for a large number of people. In this process, it serves two purposes: provides social security net to people and helps in nation building by making available investable capital. Definition. In economic terms, anything used to cut down the risk is known as insurance. But in familiar terms, insurance is provided by an insurance company which covers a person's life, called life segment, or covers loss of assets, property, called non-life or general segment. The insurance policies are purchased at fixed premiums. Insurance industry. Insurance has a deep-rooted history in India. It finds mention in the writings of Manu, Manusmriti, Yagnavalkya, Dharmasastra, and Kautilya, Arthasastra. The writings talk in terms of pooling of resources that could be redistributed in times of calamities such as fire, floods, epidemics, and famine. This was probably a precursor to modern-day insurance. Ancient Indian history has preserved the earliest traces of insurance in the form of marine trade loans and carriers' contracts. Insurance in India has evolved over time, heavily drawing from other countries, England in particular. LIC. The life insurance business or industry in the country was nationalized by the Government of India in 1956, and a fully government-owned company, the Life Insurance Corporation of India, LIC, was set up. At that time, 245 Indian and foreign companies were playing in the life segment of insurance. Opening of private life insurance companies was prohibited at that time. The LIC was called an investment institution by the government. The nationalization was motivated by twin objectives. First, to spread the message of life insurance for greater social security, and secondly, to mobilize people's savings, collected as premiums, for nation building. The LIC had been the biggest investor in the government's process of planned development, purchasing government securities, G6, and equities of the big asset public sector undertakings, PSUs. GIC. In 1971, the government nationalized the private sector companies, 107 Indian and foreign companies, playing in the general insurance segment, and a government company, the General Insurance Corporation of India, GIC, was formed in 1972. The GIC started operation on 1 January 1973 with its four holding companies: 1. National Insurance Company Limited, 2. New India Assurance Company Limited, 3. Oriental Fire and Insurance Company Limited, 4. United India Insurance Company Ltd. In the era of economic reforms, two major changes took place in this area. 1. In November 2000, the GIC was notified as the Indian reinsurer, to be known as GIC Re. 2. In March 2002, the GIC was withdrawn from holding company status of the four public sector general insurance companies. Now these four companies are directly owned by the Government of India. ASIL. The Public Sector Insurance Company, Agriculture Insurance Company of India Limited, ASIL, was set up by the Government of India in December 2002, commenced its business in April 2003. This is a dedicated agri-insurance company and aims to serve the needs of farmers better and to move towards a sustainable actuarial regime. This company was responsible to look after the National Agriculture Insurance Scheme, NAIS, which was launched in 1999. Since January 2016, the company is looking after the newly launched PMFBY, Prime Minister Fasal Bima Yojana, which subsumed the existing agri-insurance schemes, the NAIS and the modified NAIS, of 2010. Till the ASIL was not set up, the agri-insurance responsibility of the government was being looked after by the General Insurance Corporation, GIC. ASIL is jointly promoted by public sector insurance companies and development financial institutions, majority shares owned by the GIC, 35%, and NABARD, 30%, while the four public sector general insurance companies own 8.75% each in it. Public sector insurance companies. At present, there are 6 public sector insurance companies in India. Out of it, 1 deals in the life segment, LIC. 4 are involved in the non-life, general insurance segment, and 1 is the dedicated agri-insurer. Other than these companies, there is 1 reinsurance company, the GIC Re, wholly owned by the GOI. Insurance reforms. Under the process of Economic Reforms and Insurance Reforms Committee, IRC, was set up in April 1993 under the chairmanship of the ex-RBI Governor R.N. Malhotra. The committee handed over its report, January 1994, with the following major suggestions. 1. Decontrolling insurance sector, i.e., allowing Indian as well as foreign private sector insurance companies to enter the sector. The government did it in 1999, passing the IRDA Act. 2. Restructuring the LIC and the GIC and cutting down the government's holding in them to 50%, no follow-up still, but the private insurance companies demanding it anxiously. The NDA government had taken steps in this area, but the UPA government has no such plans. Late 2012, the government started sale of the LIC shares, but to public sector undertakings, seen as a welcome move. 3. Delinking GIC and its 4 subsidiaries, which was done in 2000. 4. Discarding the system of licensing of surveyors by the Controller of Insurance. 5. Restructuring the Tariff Advisory Committee. 6. Setting up a regulatory authority for the insurance industry, the IRDA set up in 2000. IRDA. The Insurance Regulatory and Development Authority, IRDA, was set up in 2000. The Act was passed in 1999 with 1 chairman and 5 members, 2 as full-time and 3 as part-time members, appointed and nominated by the government. The authority is responsible for the regulation, development, and supervision of the Indian insurance industry. Today, 57 insurance companies are operating in India, of which 24 are in life segment, while 33 in non-life segment, 1 public sector life insurer, LIC, 4 public sector general insurer, 2 specialized insurers, ACIL and ECGC, 1 public sector reinsurer, GIC Re, and 4 foreign reinsurers. India allows 49% FDI in insurance sector under automatic route. By early 2020, the government was considering to enhance it to 100%. By late 2019, the government allowed 100% FDI in insurance intermediaries. Reinsurance. Insurance is a very risky business. While the insurance companies offer insurance to its clients, they themselves get exposed to very high financial risks. Reinsurance business emerged out of this reality. When an insurance company buys insurance cover for its insurance business, a new segment comes into being, i.e., reinsurance. Experts believe that in absence of reinsurance, insurance industry in a country will not grow to the level of the social requirement, as insurance companies will either not provide insurance cover in several areas or they will charge very high premiums on the policies they offer to neutralize the risk. Keeping this thing in mind, the Government of India took initiative to convert the existing public sector general insurer, the GIC, into a reinsurance company in 2000. Known as the GIC Re, it remained the only reinsurance company in the country till now. Over the time, this emerged as a major player in the global reinsurance industry. Reinsurance industry is regulated by the IRDA in the country. Reinsurance industry has a very low penetration in India. Lack of competition has been cited as a major factor behind it. It has only 1 player by now. To promote competition and vibrancy, the IRDA announced, late 2015, to open up the industry for the entry of foreign companies. In March 2016, the IRDA gave initial approval, known as R1 in regulatory parlance, to 4 foreign reinsurance companies. Among them, to belong to Germany, Munich Re, Hanover, 1 each to Switzerland, Swiss Re, and France, SCOR. Munich Re is the largest reinsurance player in the world, while Swiss Re is the second largest, and Hanover comes third in global size. 2 other foreign companies, US-based Reinsurance Group of America and UK-based XL Catlin, are waiting for the initial approval. These companies will start their operation once they get the final approval, known as R2. Deposit Insurance and Credit Guarantee Corporation, DICOC. DICOC was set up by merging the Deposit Insurance Corporation, 1962, and the Credit Guarantee Corporation, 1971, in 1978. While deposit insurance had been introduced in India out of concerns to protect depositors, ensure financial stability, instill confidence in the banking system, and help mobilize deposits, the establishment of the Credit Guarantee Corporation was essentially in the realm of affirmative action to ensure that the credit needs of the hitherto neglected sectors and weaker sections were met. The essential concern was to persuade banks to make available credit to not so creditworthy clients. After the merger, the focus of the DCOG had shifted onto credit guarantees. This owed in part to the fact that most large banks were nationalized. With the financial sector reforms undertaken in the 1990s, credit guarantees have been gradually phased out, and the focus of the corporation is veering back to its core function of deposit insurance with the objective of averting panics, reducing systemic risk, and ensuring financial stability. Insurance cover available on bank deposits was increased from the existing 1 lakh rupees to 5 lakhs rupees by the government on 1st February 2020. The move announced in the Union Budget 2020 to 2021 was believed to come in the wake of the recent crisis related to the Mumbai-based Urban Cooperative Bank, the PMC, Punjab and Maharashtra Cooperative. For deposit insurance, depositors do not pay any premium, rather a nominal premium is collected by the DCOG from the banks. The scheme covers all banks operating in India including private sector, cooperative, and even branches of foreign banks in India, with certain exemptions like deposits of foreign governments, deposits of central or state governments, and interbank deposits. Background: in 2017 to 2018, the government proposed the Financial Resolution and Deposit Insurance (FRDI) bill, which aimed to reform the existing provisions related to deposit insurance and credit guarantee. The bill was criticized for the clause which allowed writing down of the liabilities of the failed bank. This clause was inferred by stakeholders as the bail-in clause when a financial help comes in from within the bank or financial institution. The Joint Parliamentary Committee also had certain apprehensions related to it. Government withdrew the bill in July 2018 and announced the need of more time to examine the related issues. Since 1991, the deposit insurance limit has been up to only 1 lakh rupees. Many countries revised their deposit insurance limits after the global financial crisis of 2008. The limit was increased up to $1.15 lakh in UK, set around 3 to 4 times of the per capita income of these economies. Emerging economies like Brazil and China have set this limit at 9 times of their per capita income. In case of India, it was still a little over its per capita income, which was estimated to be 1,11,782 rupees at constant market price, as per the Economic Survey 2017 to 2018. Export Credit Guarantee Corporation, ECGC. The overseas projects undertaken by the Indian companies face many political and commercial risks in the importing countries. To provide adequate credit insurance cover to such firms, the government has set up the Export Credit Guarantee Corporation of India Limited, ECGC, under the Ministry of Commerce and Industry, for medium and long-term exports. But owing to its own limitations, at times it is difficult for ECGC to cover pure commercial risks in issues like long repayment period, the large value of contracts, difficult economic and political conditions of the importing country, together with the fact that reinsurance cover is generally not available for such projects. Many times, such projects look necessary considering the economic and political relationship of India with the proposed importing country. It means that in the absence of credit insurance cover, the ability of Indian exporters to go for such export projects is hampered. It should be noted that in many developed economies, such projects are covered and underwritten on government account. National Export Insurance Account, NEIA. For facilitating the service of the ECGC, discussed above, the Government of India did set up the National Export Insurance Account, NEIA, in March 2006 to promote medium and long-term export by providing credit insurance support in the cases where ECGC was not able to provide credit cover on its own because of purely commercial reasons. 1. The corpus given to the account was 66 crore rupees, raised to 246 crore rupees by 2007-08, and was enhanced to 2,000 crore rupees in the 11th Plan, 2007-12. 2. Resources of the NEIA will be the corpus, the premium income, interest income, and recovery of all the claims paid. 3. As per the provision, an exposure equal to 10 times corpus can be taken by the NEIA. The NEIA can cover projects which fulfill the following criteria. 1. The project by itself should be commercially viable. 2. The project should be strategically important for India with regard to economic and political relationship of India with the importing country. And 3. The exporter should be capable of executing the contract, as evident from his previous track record. The use and benefits of the NEIA need to be publicized among its beneficiaries. Meanwhile, many export projects pertaining to Indonesia, Vietnam, Iran, Sudan, etc. are underway. The NEIA will facilitate potential project exporters to enter the international trade area, as it is expected to be so. In the era of globalization, it has been praised as a welcome development by the experts and the trade people alike. The challenge ahead. Since the opening up of the insurance sector, the number of participants in the insurance industry has gone up from 7 insurers, including the Life Insurance Corporation of India, LIC, 4 public sector general insurers, 1 specialized insurer, and the General Insurance Corporation as the national reinsurer, in 2000 to 52 insurers as on 30th September 2012 operating in the life, non-life, and reinsurance segments, including specialized insurers, namely the Export Credit Guarantee Corporation and Agricultural Insurance Company, AIC. 4 of the general insurance companies, viz. Star Health and Alliance Insurance Company, Apollo Munich Health Insurance Company, Max Bupa Health Insurance Company, and Religare Health Insurance Company function as standalone health insurance companies. Of the 23 insurance companies that have set up operations in the life segment post-opening up of the sector, 21 are in joint ventures with foreign partners. Of the 21 private insurers who have commenced operations in the non-life segment, 18 are in collaboration with foreign partners. After the state monopoly in the insurance sector was dismantled and private players' entry allowed, the IRDA has played a crucial role in the development and expansion of the sector. There is no doubt in it. But still the sector faces many challenges which, if only tackled well, may one say that insurance is serving the interests of the insuring companies and the covered alike. As per the concerned experts, the major challenges Indian insurance is facing today may be seen as given below. 1. As per various estimates, only 20% of the insurable Indian population is life insured. The share of India in global life insurance is just 0.66%, and life insurance penetration is at present 2.53%, 2004, in the country. The message of life insurance needs to be publicized among the population, especially in the rural areas. Moreover, social security schemes should be expanded to cover the poor masses who lack the premium paying capacity. 2. Experts suggest that health insurance could emerge among the most important factors of improving human development in the country if expanded in a focused way and via an action plan. It is estimated that around 15% of the Indian population is covered under some form of prepayment on healthcare, which includes employees and beneficiaries covered under SS, CGHS, armed forces, central police organizations, railways, employer self-funded schemes, the PSUs and pensions covered under health insurance. As the out-of-pocket expenditure in India is as high as 70%, it is believed that the health insurance sector in the country needs strong presence. As per the NSSO, 2015, the coverage of the government-funded health insurance schemes are 13.1% in rural areas and 12% in urban areas. Economic Survey 2015-16. 3. After the general insurance industry was opened up, 2000, for the private sector participation, the experience has been positive. Its growth compares favorably with that of many other emerging markets and is in line with global benchmark of 2 to 3 times the growth in GDP. As the economy is on a strong growth path and the capital expenditure plan across industries is estimated to be over 9 lakhs crore rupees over the next 4 to 5 years, a better scope for the general insurance expansion is probable. The growth in both commercial and personal lines of general insurance business reflects positive trends. Over 70% of India's population lives in rural areas, and along with organized financial services, general insurance companies are also expanding into these sectors. 4. People in their lives experience financial difficulties that can affect the entire family negatively. This is more true about the poor masses in India. This is why experts suggested for the provision of micro-insurance. A relatively new concept, micro-insurance is today provided to the beneficiaries of microfinance covering the finance amount, reducing the risk of the clients as well as the microfinance institutions, MFIs. The concept of micro-insurance has been developed by the private insurance company Aviva Life Insurance, in partnership with MFIs, which has forged alliances with banks like Canara Bank, PNSB, RRBs, 23 cooperatives, etc., to promote microfinance. Microinsurance has evolved in the past to decades of research in microfinance and has seen growth in countries like Sri Lanka, Philippines in the last decade. Here NGOs and people's organizations are allowed to register themselves as micro-insurance companies which sell such insurance. As they cover the risk themselves, they are allowed to reinsure with one of the large global companies like Swiss Re or Munich Re. Same model is suggested for India, but for this to happen drastic changes in the existing insurance rules are required. 5. Many of the experts believe that insurance industry should benefit the insurers, reinsurers as well as the insured. The social purpose of the insurance sector is never praiseworthy to be marginalized by the corporate interests, be domestic or foreign. At least it does never taste good in India, which needs a strong social safety net. 6. Almost all of the private insurance companies in India have been demanding that the government-owned insurance companies, i.e., LIC, and the 4 general insurance companies, should be converted into private sector companies. Their reasons are logical, as in comparison with the government-owned insurance companies, private companies are always ready with highly attractive and lucrative insurance schemes, but they have not been able to attract the clients for them. Therefore, the private insurance companies have been fetching huge operational losses due to lack of the desired level of their expansion and the overhead expenditure. Insurance penetration and density. The growth in the insurance sector is internationally measured based on the standard of insurance penetration. Insurance penetration is defined as the ratio of premium underwritten in a given year to the gross domestic product, GDP. Likewise, insurance density is another well-recognized benchmark and is defined as the ratio of premium underwritten in a given year to total population, measured in US dollars for convenience of comparison. The Indian insurance business has in the past remained underdeveloped, with low levels of insurance penetration. At present, the calendar year 2018, the insurance penetration and density of India are as given below. Insurance penetration is at 3.71%, 2.74% for the life segment, and 0.97% for the non-life segment, at the global average of 3.31%. The comparative figures for Malaysia, Thailand and China during the same period were 4.84, 5.56 and 4.32 respectively. In case of India, it was 2.71 in 2001 and the highest ever at 5.20 in 2009. The penetration for life segment has fallen down from 3.40% of 2011, while penetration for the non-life segment has been increasing since 2011, when it was 0.70%. Insurance density is at $74, US 19 for non-life, against the global average of US 518, US 406 respectively. It was $11 in 2001 for India. Reasons for underdevelopment of insurance. As per the various volumes of the annual reports published by the IRDA and other government documents, there have been several reasons responsible for the underdevelopment of the insurance penetration and density in the country. 1. Complex and delayed claim settlement procedures. 2. Vague and incomprehensible rules and regulations of the insurance companies. 3. Lack of education and awareness among the masses. 4. Lower income levels of the population. 5. Sociocultural factors. 6. Lack of level playing field in the industry. And 7. Less vibrancy in the regulatory framework. Recently enacted Insurance Laws Amendment Act 2015 is supposed to have positive impact on regulatory framework as well as insurance penetration. Policy initiatives. Committed to expand and strengthen the insurance industry in the country, following the recommendations of the Malhotra Committee Report, 1993, the Government of India has taken the following policy initiatives in recent years. 1. Health insurance. The Insurance Regulatory Development Authority, IRDA, has been taking a number of proactive steps as part of the initiatives for the spread of health insurance. It had set up a National Health Insurance Working Group in 2003, which provided a platform for the various stakeholders in the health insurance industry to work together and suggest solutions on various relevant issues in the sector. The IRDA is also coordinating with and supporting insurance industry initiatives in standardizing certain key terminology used in health insurance documents for better comprehension and in the interest of policyholders. The General Insurance Council, comprising all non-life insurers, evolved a consensus on a uniform definition of pre-existing diseases and its exclusion wording, which has earlier been an expression with many definitions, still more interpretations, and certainly a whole lot of grievances. Such standardization, effective 1 June 2008, will help the insured by minimizing ambiguity and also by better comparability of health insurance products. Also, with effect from 1 October 2011, portability in health insurance has been started, in which an insured, if not happy with services or the product of the existing insurer, can change to another insurer whilst enjoying the benefits, especially that of pre-existing diseases, of her or his existing policy. 2. Micro-insurance. Micro-insurance regulations issued by the IRDA have provided a fillip to propagating micro-insurance as a conceptual issue. With the positive and facilitative approach adopted under the micro-insurance regulations, it is expected that all insurance companies would come out with a progressive business approach and carry forward the spirit of regulations, thereby extending insurance penetration to all segments of the society. Presently, there are 10,482 micro-insurance agents operating in the micro-insurance sector. New reform initiatives. With a view to removing archaic and redundant provisions in the insurance laws, empowering the Insurance Regulatory and Development Authority (IRDA) to enable more effective regulation, and enhancing the foreign equity investment cap in an Indian insurance company with the safeguard of Indian ownership and control, the government has implemented the Insurance Laws Amendment Act 2015. The Act paved the way for major reform-related amendments in the Insurance Act 1938, the General Insurance Business Nationalization Act 1972, and the Insurance Regulatory and Development Authority (IRDA) Act 1999. It provides greater powers to the IRDA by which the insurance regulatory framework is supposed to become more flexible, effective, and efficient. Major changes as per the Act are given below. 1. Promotion of foreign investment in an Indian insurance company increased from 49% from 26%, with the safeguard of Indian ownership and control. Greater availability of capital for the capital-intensive insurance sector would lead to greater distribution reach to under or unserved areas, more innovative product formulations to meet diverse insurance needs of citizens, efficient service delivery through improved distribution technology, and enhanced customer service standards. 2. Capital requirement in government companies, the public sector general insurance companies. 4. Presently required as per the General Insurance Business Nationalization Act 1972 to be 100% government-owned, are now allowed to raise capital. This will enable them to have additional capital for the purposes of business expansion in the rural or social sectors and enhanced competitiveness. The Government of India ownership to be maintained minimum at 51%. 3. Consumer welfare. It will enable the interests of consumers to be better served through provisions like those enabling penalties on intermediaries or insurance companies for misconduct, and disallowing multi-level marketing of insurance products in order to curtail the practice of niche selling. The amended law has several provisions for levying higher penalties ranging from up to 1 crore rupees to 25 crore rupees for various violations including niche selling and misrepresentation by agents or insurance companies. B. With a view to serve the interest of the policy holders better, the period during which a policy can be repudiated on any ground, including misstatement of facts, etc., will be confined to 3 years from the commencement of the policy, and no policy would be called in question on any ground after 3 years. C. The amendments provide for an easier process for payment to the nominee of the policyholder, as the insurer would be discharged of its legal liabilities once the payment is made to the nominee. D. It is now obligatory in the law for insurance companies to underwrite third-party motor vehicle insurance as per IRDA regulations. Rural and social sector obligations for insurers are retained in the amended laws. 4. Empowerment of IRDA. The Act will entrust responsibility of appointing insurance agents to insurers and provides for IRDA to regulate their eligibility, qualifications, and other aspects. A. It enables agents to work more broadly across companies in various business categories, with the safeguard that conflict of interest would not be allowed by IRDA through suitable regulations. B. IRDAI is empowered to regulate key aspects of insurance company operations in areas like solvency, investments, expenses and commissions, and to formulate regulations for payment of commission and control of management expenses. C. It empowers the authority to regulate the functions, code of conduct, etc., of surveyors and loss assessors. It also expands the scope of insurance intermediaries to include insurance brokers, reinsurance brokers, insurance consultants, corporate agents, third-party administrators, surveyors and loss assessors, and such other entities as may be notified by the authority from time to time. D. Further, properties in India can now be insured with a foreign insurer with prior permission of IRDAI, which was earlier to be done with the approval of the central government. 5. Health insurance. The Act defines health insurance business inclusive of travel and personal accident cover and discourages non-serious players by retaining capital requirements for health insurers at the level of 100 crore rupees, thereby paving the way for promotion of health insurance as a separate vertical. 6. Promoting reinsurance business in India. It enables foreign reinsurers to set up branches in India and defines reinsurance to mean the insurance of part of one insurer's risk by another insurer who accepts the risk for a mutually acceptable premium, and thereby excludes the possibility of 100% ceding of risk to a reinsurer, which could lead to companies acting as front companies for other insurers. 7. Strengthening of industry councils. The Life Insurance Council and General Insurance Council have now been made self-regulating bodies. By empowering them to frame bylaws for elections, meetings and levy and collect fees, etc., from its members. Inclusion of representatives of self-help groups and insurance cooperative societies in insurance councils has also been enabled to broad-base the representation on these councils. 8. Robust appellate process. Appeals against the orders of IRDAI are to be preferred to SAT as the amended law provides for any insurer or insurance intermediary aggrieved by any order made by IRDAI to prefer an appeal to the Securities Appellate Tribunal, SAT. 9. Capital market reforms. In March 2019, the IRDAI announced the redesigned Initial Public Offering (IPO) guidelines for insurance companies which are looking to divest equity through the IPO route. Now insurance companies are allowed to invest up to 10% in additional Tier 1 bonds issued by banks, which are raising capital to comply to Basel Ii norms. Thus, the amendments incorporate enhancements in the insurance laws in keeping with the evolving insurance sector scenario and regulatory practices across the globe. The amendments will enable the regulator to create an operational framework for greater innovation, competition, and transparency to meet the insurance needs of citizens in a more complete and subscriber-friendly manner. The amendments are expected to enable the sector to achieve its full growth potential and contribute towards the overall growth of the economy and job creation. Third-party insurance. The third-party insurance is provided by non-life insurance companies on vehicles. This insurance covers the risk on other than the two parties, i.e. the car and the owner, in case of a car involved in an insurance policy. The policy does not provide any benefit to the insured. However, it covers the insured's legal liability for death or disability of third-party loss or damage to the third-party property. This insurance is also known as Act-only cover. In India, it is mandatory, under the Motor Vehicle Amendment Act, 2019, for all new two-wheelers to have a 5-year third-party insurance and cars and commercial vehicles to have a 3-year third-party insurance. The cost of a comprehensive cover. is several times that of a standalone third-party cover, since damage claims are more frequent than third-party claims. Until now, the premium for motor third-party insurance was calculated on the basis of a schedule of rates provided by the Tariff Advisory Committee, an arm of the IRDAI, the insurance regulator. But IRDA has done away with the motor tariff. The compensation to the victim is largely decided by the earning capacity of the accident victim. To make insurance policies of vehicles cheaper, insurance companies have been charging a very low premium for such policies. Due to this, insurance companies have not been settling third-party insurance claims quicker, majority of case going for litigation. But in recent years, the IRDAI has taken various steps to strengthen this segment of the non-life insurance. By early 2020 to 2021, the IRDAI announced a market-linked increase in the insurance premium for the third-party insurance together with enforcing a stricter regulatory regime for quicker settlement of the third-party claims. New insurance schemes. Till April 2020, the Government of India had launched few new insurance schemes aimed at creating a universal social security system for all Indians, especially the poor and the underprivileged. Salient features of these schemes have been briefly discussed below. PMSBY, Pradhan Mantri Suraksha Bima Yojana. It offers a renewable one-year accidental death cum disability cover to all subscribing bank account holders in the age group of 18 to 70 years for a premium of 12 rupees per annum per subscriber. The risk coverage available will be rupees 2 lakh for accidental death and permanent total disability and rupees 1 lakh for permanent partial disability for a one-year period stretching from 1st June to 31st May. PMJJBY, Pradhan Mantri Jeevan Jyoti Bima Yojana. The scheme offers a renewable one-year term life cover of rupees 2 lakh to all subscribing bank account holders in the age group of 18 to 50 years. NHPS, National Health Protection Scheme. In September 2018, Government launched the NHPS under Ayushman Bharat to provide coverage of up to 5 lakh rupees to more than 50 crore vulnerable families, 10 crore families. The scheme is expected to increase penetration of health insurance in India from 1934% to 50%. Road ahead. The future looks promising for the life insurance industry, with several changes in regulatory framework which will lead to further change in the way the industry conducts its business and engages with its customers. At present, latest for 2018, India's share in global insurance market is 2%. However, the total insurance premium in India increased by 10.4%, whereas global insurance premium increased by 1.4% only. India's insurance industry is expected to reach $280 billion by 2020. Life insurance and non-life insurance industries in the country are expected to grow annually by 13% and 10% respectively for the next 5 years. Demographic factors such as growing middle class, young insurable population, and growing awareness of the need for protection and retirement planning will support the growth of Indian insurance industry.